Pressure from yesterday has yet to abate. It seems to have really started with some of the refinancing concerns, but there's a lot in there, and all of that made yields go higher globally and forced the BOJ's hand yet again. They stepped in unscheduled bond buying. As a result, you are seeing the yen weaken. That's the dollar gain ahead of it. A quick snapshot of your futures picture as we're less than 30 seconds away from the start of cash equity trading here in Europe. Underperformance from the DAX. Is that Infineon earnings? We'll get to that throughout the show. FTSE 100 futures also in the lows for the morning session. CAC 40 futures, those are down 0.7%. So just moments away from the open, and we've seen futures deteriorate. What will that mean for this open and for the entirety of this session when we saw global stocks yesterday have their worst day of their year, the worst day since December 2022. All right, here we go, straight out of the gate. As always, it's the FTSE 100. It is not down too much at the moment, but that's likely to pick up steam as more of these stocks open. Down at the moment for about 0.1%. Elsewhere, you can see definitely how the risk picture is shaping up. You can see the dollar that is gaining versus everything else ahead of a BOE decision. Again, something else we're going to talk about a lot in the day. Now, as I mentioned, and as I said, as things are opening up, those little change in the FTSE 100 would deteriorate. It has. It's down now 0.6%. France opens up to the downside too, also down 0.8%. Spain's IBEX, that's down 0.5%. Now the DAX is usually one of the last ones to open, but that one I'm really interested to see. Again, just because Infineon was down some 5%, 5.2% even more in the trade gate session, so that's likely to weigh on the entirety of the chip sector because of those supply chain concerns, specifically when it comes to cost, that things are still expensive. Their margins did miss. Okay, Italy opens up down 0.5%. Let's go ahead and take a look at the sectors again as we're getting more of these markets opening up. Now we're taking a look at it without the DAX. Even still, just want to point out what's all the way over on this side of the screen. It's technology. That is down 0.75%. It's been pretty spotty when it comes to the different chip earnings, but Infineon adding to the downside. We're also going to get Qualcomm, so that should shake things up yet again. The one sector that's outperforming today are banks, up 0.2%. Perhaps that is following on from higher yields too, but elsewhere you can see it's pretty negative. Food is little change, but down 0.5% for a lot of these indices. Financial services down 1.1%. We did get some insurance earnings. We got AXA today. They're doing a new deal. Will be interesting to see whether that's feeding into that. Okay, let's get to some of the other top stories. Christine Aquino now joins us from our Markets Today blog. Christine, we were just talking about the BOJ. I got to say, I said to Mark, oh, is it 5.5 basis points? Is that the BOJ's limit? And he just kind of straight up destroyed me and was like, that's such an arbitrary number, 5.5, why not 5? But I mean, does it seem like they're targeting more the speed at this point versus the level, or is it just kind of like, we still have no idea?
Yeah, I think you're absolutely right, Danny. I think the speed of the rise in yields in Japan is really what the Bank of Japan is quite unhappy with. Remember, the Bank of Japan, probably one of the most, if not the most cautious central banks among developed economies. They're the last ones out of the gate in terms of exiting super easy monetary policy. And you can really see the caution that's pervading in the way that they approach this. Even though they've taken a baby step towards policy normalization, they really don't want markets to kind of move too far too fast. And that is the nature of markets though, right? Traders will tend to push central banks one way or another quite quickly, perhaps quicker than policymakers would like to. And this is really the Bank of Japan pushing back on a lot of that.
And, you know, at the same time, and this is part of this global story of yields moving higher, Christine, I just wonder what you make of that. It's getting worse as the market has been opening. 30-year yields down 8 basis point, 20, almost 9, 10-year, almost 7.5. This bond sell-off, it's not easing. Usually we take a break at this point of the day, but it's not.
No, it really isn't, Danny. And I think, of course, that is still the ripple effect of the Fitch credit rating cut for the U.S. yesterday that we're seeing. But I think ultimately also, this is kind of the steepening action in the yield curve that we've always been afraid of, right? I mean, the discussions about the yield curve has moved on from, it's the most inverted in however many decades or so. But it's the steepening that follows after that a lot of investors have come to be afraid of. And it seems like we're seeing a little bit of that now, of course, because of the longer term concerns that investors have over the impact of higher rates on things like U.S. government borrowing costs, for instance. I mean, that's certainly something that Bill Ackman is citing as one of the reasons why he himself is shorting U.S. Treasuries.
That is such a good point, because we are not bull steepening. We're not steepening because inflation has been solved. We are bear steepening at this moment, which is always kind of concerning. Christine, thank you so much for joining us. Christine Aquino from our Markets Today blog. And you can always get more from the team on the front pages of the Bloomberg UK website or by typing TLiveGo on your terminal. All right, let's get some of the individual stocks on the move with Joe Easton. Joe, I see you have some positive stories there, which we need, because I'm looking at some of these earnings having some pretty ugly moves on the stocks. What do you see?
So here's how these financial stocks are opening up. Danny, SocGen actually rising despite that big drop in their trading revenue. As we said in Stocks to Watch, that stock really had a low valuation. A lot of people do like that, so potentially just coming back up a tad for that one. ING up around 1% over in Amsterdam. That was a pretty mixed one. They did have a better than expected loan loss provision, partly due to some of their geopolitical risk measures that they take. Lloyds, this is dropping. This is purely ahead of the Bank of England. Higher rates no longer benefiting those UK lenders. My colleague Leonard also has a really good update on the terminal, a good report out on how interest rates are affecting those. Check that one out on the terminal. London Stock Exchange slammed down 6%. That's a big move for that one. Some of their data and analytics business not doing as well as expected. We had the CEO on the show just a moment ago as well. In terms of some of those consumer stocks, a few big ones to look at today. Next, that one up 0.3%, another boost to trading guidance. However, not as big as it was last time, so we're not seeing a huge gain there. Adidas, some of the concerns around the Kanye West partnership now starting to fade as they sell down a lot of that stock. Their earnings were pretty strong on the terminal as well. Berestorff, this is the owner of Nivea Cream. They've got a positive update out, but that one's pretty uncertain. A lot of supply chain issues still hitting that one as well. And Merck, now interestingly, they actually have a technology business. This is, of course, the pharmaceutical and chemical company, but they've got a tech business as well, and that seems to be the strong point on that report today. Finally, just going to flip over to a couple of others. So Wizz Air, this is obviously the Eastern European focused short haul company. Now they are actually losing quite a lot of market share, and they're operating in areas where there's not much growth to get at the moment, given the declines in the economy. Also seeing a drop in Lufthansa. Now that one looked pretty strong to me. I think there is a boost to the long haul market at the moment, but maybe priced in. I'll have to read up on that one when I get back to my desk. The big dropper over in Germany, though, Infineon, you mentioned just a moment ago that profit warning from them. They are still not recovering from the semiconductor shortage issues, and that one down 9%, the worst one on the DAX. Finally, also in Germany, I've brought up Telefonica Deutschland. That one fell 18% yesterday in a record plunge after news that Vodafone has got a new partnership over in Germany, encroaching more on their territory. And I expected that one to come back up today, but it's dropping another 3%, a record plunge for Telefonica Deutschland.
Wow, Joe, a lot of things on the move there. Some big losses, Infineon included, as you pointed out. Joe Easton there from our equities team. Thank you so much. Coming up, it's BOE decision day. We're expecting the central bank to raise rates for the 14th time in a row. Will it be 25 or 50? More on that next. This is Bloomberg.
York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Bloomberg.
This is Markets Today, 10 minutes into your European trading session. It is another down day, losses of more than 0.5% for most of these indices as the Treasury sell-off continues to gain with some fuel. Perhaps that's adding to the extra pressure on equities. Let's talk about central banks, though, and the BOE is expected to hike rates by at least a quarter point at its meeting later today. It would be the central bank's 14th consecutive rate hike. Let's get the backdrop with Bloomberg's Lizzie Burton, who is at Threadneedle Street outside the Bank of England. Lizzie, what's expected?
Yeah, Danny, it's a lovely day here on Threadneedle Street, just across the road from where you are, and markets are on the knife edge. They've fully priced a quarter point hike from the Bank of England today, but they do see a strong chance that it's a 50 basis point rise from the current 5%. We, of course, saw a 50 basis point move at the last meeting, and the vote split around it was a hawkish one. Since then, you've had the archdove of the committee, Silvana Tenreiro, replaced by Megan Green. That's thought to have left the balance of the committee more hawkish. But the reason why economists reckon you'll get 25 basis points today is because of that cooler than expected June inflation print. It is still nearly 4 times the Bank of England's target, though, which is why more hikes are seen in the pipeline. But traders have pulled back where they see the peak rate to now 5.75%. So in terms of the vote split today, our economists at Bloomberg Economics reckon you're going to see a 3-5-1 split. 3 for 50, 5 for 25, and 1 for a hold. And the language around the decision likely to echo the Fed and the ECB, leaving the door open, maybe to a hold, maybe to another hike next time, but very much dependent on the data.
Well, look, Lizzie, at the moment, we've got £800 billion worth of a runoff in the balance sheet annually. Could the BOE change to outright sales?
Well, we did have a signal from the Deputy Governor, Dave Ramsden, last month that we can expect an announcement on quantitative tightening in September, a speeding up of QT. This because it seems to be going like clockwork. There hasn't been a lot of impact on gilt yields, and essentially he wants to press the reset button as soon as responsibly possible so that they can restore the armory in case of another crisis. But the speculation has been that actually we get that announcement today at the August meeting. The speculation coming from the likes of Capital Economics, BNP Paribas, because there is precedent. The last big QT announcement was also at the August meeting, because don't forget, Danny, they have the advantage of a presser today. So maybe that's the surprise alongside a 50 basis point hike.
They have the advantage of summer markets, and maybe some people aren't looking, but maybe that means more volatility. Lizzie, thank you so much. Bloomberg's Lizzie Burton, who will be outside of the BOE for your coverage all day. Joining us now for more on this is our expert panel this morning. It is Sylvia Ardengagna, Chief European Economist at Barclays, and Kim Crawford, Global Rates Portfolio Manager at JP Morgan Asset Management. Thank you both so much for joining this morning. Let's just start with the basics. Sylvia, I'm going to pick on you first. 25 or 50, what are we going to get today?
We are for 50 today.
And why?
And I would say three main reasons. One, last time they did 50, it was unexpected to us, but we think the reason was that they saw second round effects from the inflation to wages crystallizing. And so if that's the case, we think that that deserves more than one big hike. The second reason is that today, as your colleague Lizzie was saying, they have a press conference and they're also updating forecasts, so it might be easier also to discuss why they have speed up and what they're going to do next. We expect a 25 basis points then in September. Third reason, data. They've been mixed, so we acknowledge that there is a risk, but while we have seen inflation surprising to the downside, the surprise has been relative to analyst expectations, not to the NPR report that they put out in May, and wage growth remains quite high. To the tune of 7% or more. So
okay,
based on that.
This is exciting, Sylvia and Kim, because I think we're going to have a bit of a healthy debate here. And just to lay it out, the market is split too, so you both are perfect because Kim, I think you see things slightly differently.
Yeah, we've got two sides of the coin this morning. We're going for 25. The reason is we think the last time they did 50 was because of the scale of the upside surprises that they saw in services inflation and also wages. And we think the data from then has just been a bit more moderate and mixed. So I'm sitting on the Monetary Policy Committee today. I'm not feeling that same amount of pressure to reassert my inflation credibility that I did back in June. You know, we've had 4 bumper upside surprises in inflation this year, but we finally had a downside surprise, as Sylvia mentioned, relative to market expectations. Headline inflation also came in line with the bank's forecast, 7.9%. That hasn't happened since the start of this year. Inflation expectations we saw yesterday, they are falling, so 5 to 10 year ahead. They're finally below their long run average. The 1 year ahead also fell significantly. And then lastly, the labor market, we are finally seeing a bit of hard evidence, not just soft, but also hard, that it's starting to loosen. You know, it's still very tight, wages still very high, but it's starting to loosen, which moving forward could alleviate wages maybe if that continues.
Can I kind of ask this in another way, which I'm interested again to get both your thoughts on. What is the risk for the BOE right now? Is it doing too much or too little? Sylvia, I'll start with you again.
Look, we still think it's doing too little because we have the terminal rate at 5.75. So for risk management considerations, right, if you think about it, you could even do, you know, if you are worried about doing too much, you can go for 50 today and then perhaps pause or skip or, you know, end the cycle. But you hedge yourself in a sense. If you're going to have another upside surprise in inflation later on, then what do? You go back to 50 again? In a sense, it boils down, I think, to how much forward-looking the central bank is, whether their reaction function, in a sense, whether has changed and has internalized the second round effects more. And if so, you want to be upfront. Otherwise, if it's just, you know, as Kim sees it, going after the latest data point surprise, then I agree, you would go for 25.
Okay, I'm going to push Sylvia on behalf of you, Kim, because I think you might be too kind to do it. To play devil's advocate, what's the difference between 25 and 50 at this point? I mean, can't they afford to just slow, like, it's not like they're pausing if they do 25. Can't they afford to just kind of slow down given the most recent data points?
I think, I mean, in the big scheme of things, I think you're totally right. What will matter for the real economy is the cumulative amounts of hikes you do over the next 2 or 3 months, right? So how you space it in time might, at first sight, be not that important. But I think it matters for one, credibility, and 2, risk management. Again, would it make sense to go to 25? And then, given the huge uncertainty we have on the outlook for inflation, what if then we have another upside surprise next month? You go back to 50. It will look really like a central bank that gets after the latest data surprise rather than communicate a framework and a big strategy behind it.
So that's interesting, the question of is the risk too much or too little? It's also a question of credibility, not just the economy. Kim, how do you see that balance in terms of is the risk too much or doing too little?
Yeah, for us, I think the worry in them delivering 50 at this point, when inflation has actually come in line with their forecast, is that markets start to get worried about their reaction function again. If we get inflation in line the next print, are we going to see another 50? And then just what the probabilities that the market's going to start pricing might cause a bit of panic in the front end of the yield curve, which is not what the bank is going to want to see, because that feeds into mortgage rates. But like Sylvia, we don't think this is going to be their last hike. They can't be complacent. They're going to have to leave it data dependent and open. You know, I think what we've had is relief in inflation, that it's not getting worse. But one print, it's not decisive. It's not a key turning point. It's just one tentative step in the right direction. But looking ahead, if we look at the four big components, so you've got energy, food, core goods, and core services. And we know the price caps are going to get reset next month. So energy is going to weigh down on headline inflation a lot. If we look at PPI and the PMIs, we're pretty confident food and core goods is going to keep trending lower. And for us, the ambiguity is in core services. And that's where the labor market is still tight, although it's loosening. Wages are still strong, although they're falling. And we're going to need to see and look at that for a few more months.
Well, if we have a market right now where sterling has been strengthening since the last decision, yields are on 10 years are not too far away from that 2008 high, is the pain trade then yields down at this moment? Again, if we are going to see some of those inflationary pressures begin to unwind further?
Yeah, so for a long time for us, we won favoring UK government bonds, but we've actually shifted that recently. And that's because we think we're getting that first signs that the UK might be joining the global disinflation trend. You know, we saw in the services PMI, the prices charged component as well. That's finally caught down to its global peers. So maybe it's starting to look less like a global outlier, and the valuations are very attractive, especially if you look at it versus Germany and the US. So we want to be involved, and we're favoring some UK government bonds in our portfolios.
Okay, walk me through then as well, if this is a fragile market that's perhaps priced for something else. Do you think that that pricing right now in this market is wrong? Again, if we are having yields really high, have we not fully grasped some of the disinflation that might be down the road?
I mean, we also think that this inflation will come, but particularly in the UK, will be a touch stickier than in other markets, because the labor market is still hot, as Kim was saying, and wages are still very high. So on the core service components, there will take more time for that to go down. So yes, I mean, at some point we will see this inflation. We certainly will have another continuation of headline inflation to decelerate. Non-energy goods inflation is also going down, both from the global components, and you were mentioning sterling. Certainly a stronger exchange rate helps through that channel to fuel in this inflation. But on the other hand, core service inflation is likely to remain sticky for longer.
Right. I mean, I think both of you just really emphasize sort of the nuance of these things. Look, quickly, Kim, I just want to ask you this before we let you go, because it's a strange day for the bond market. Yields have continued to pick up through this conversation. Back ends were now higher by 9.5 basis points. We're looking at Japanese yields back above where they were before the BOJ stepped in this morning. What do you make, again, apologies, we got to be quick here, but what do you make of the sell-off that we've seen?
Yeah, we think it's been the perfect storm over the last 2 days. You know, we had the Fitch downgrades followed by bigger refunding announcements in the US, and then we hit big technical levels across the Treasury curve. So that's exacerbated a lot of the move. Ultimately, we still think the direction of yields is lower, and we're pretty confident in the lower growth, lower inflation story in the US. But right now, we are favoring European and UK government bonds. We think probably too little is priced for cuts in Europe, given the trajectory of the data compared to the US next year. So there's some value there. And as I mentioned earlier, value in the UK as well.
You brought it back to the UK. What a perfect way to wrap this up. Thank you both so much for joining. Will certainly be interesting to see what the BOE goes with today. That is Sylvia Ardagna at Barclays and Kim Crawford at JP Morgan Asset Management. And don't miss our coverage of the Bank of England's policy decision midday at UK time, with the press conference 30 minutes later. And we're going to be sitting down with the BOE Governor Andrew Bailey, 4 p.m. UK time. Stay tuned for that. This is Bloomberg.
adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today. We're about 25 minutes into your European trading day. Look, it's a difficult day out there for this bond market. Equities aren't doing great either. We've seen some individual losses based on earnings. But look at what's happening to the curve. You're really seeing duration getting hit hard. The long end of the curve, the moves are higher by about 8 basis points. We were just talking to our panel there, the experts, Kim from JP Morgan, saying that they prefer UK bonds at this moment. Well, we certainly are not preferring duration in the US. The impact that is having on JGBs is a yield that's now made a round trip since the BOJ stepped in with their unscheduled bond buying this morning. We're basically back to the levels, if not slightly under it, but we're near 66 basis points. It's not great news. And again, we're going to have a BOE decision. If they do surprise to the upside, we've seen before the ability of gilts to bully around this global market. If we get something that looks like a more hawkish decision than expected, what's going to happen to these very fragile summer markets? Speaking of fragility, we're going to talk about Infineon again. It has been plunging this morning, down more than 11% after the chipmaker's outlook missed estimates. We'll dive into the details next. This is Bloomberg.
Capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate
if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
This is Market Today, 30 minutes into your European trading day, and here are your top stories. Double dose, JGB yields make a round trip after the BOJ stepped in with more unscheduled bond buying, but the sell-off resumes. Stocks are also selling off as hot U.S. jobs data and the debt deficit keep pressure on the Fed's inflation fight. A quarter or a half, 25 and 50 basis points are in play at today's Bank of England decision. We're live from Threadneedle Street. Plus, when the chips are down, most definitely down, Infineon plunges the most in 3 years as Germany's largest chip maker forecasts margin and revenue below estimates. It's a tough day whether you're looking at bonds or equities. We're now at the lows for the session. Losses of more than 1% across the board. FTSE 100 down 1.25%. Some tough earnings for a lot of different companies. We've spoken to a lot of them today. Joe Easton's going to go over that very shortly. We're also getting pressure from this bond market. The sell-off is accelerating. 30-year yields are higher by nearly 8 basis points. They're at the highest level of this year. It also means that JGBs, despite a BOJ that stepped in this morning, they're back at the levels before where they had their unscheduled bond buying operation. So that's some of the indices. Look at some of the individual sectors on the move this morning. And again, it's likely to be tech that was hit hard because of those Infineon earnings. At the same time, okay, look, everything is in the red here. There isn't a single sector spared this morning. Tech is indeed the worst, down 2%. Basic resources, also one of the worst, that's down 1.5%. Iron ore this morning did drop below $100. It's slightly back above that, but it's getting pummeled. It's down 4%, hence why you're seeing some of the basic resources do poorly. Travel and leisure, auto parts, consumer goods, all of those at the bottom of the pile too. All right, let's dig through this and get a check on some of the individual stocks on the move with Joe Easton. Joe, what you got?
So these are some of the biggest decliners half an hour into trading. Danny, London Stock Exchange absolutely slammed in the opening few minutes, down around 6%, but had come back up a bit to down 3%. That was at one point the worst drop in 2 years for that, given a decline in some of their data and analytics business, which is a key focus for them. Wizz Air, meanwhile, the Eastern European airline, now they are targeting markets that don't have much growth at the moment and actually losing a bit of market share, according to analysts following their report today. Tenorus, one we don't look at too much. This is an Italian steel piping maker seeing some declines in its North American business, so that potentially an indicator of what's going on in the US construction market at the moment. At the bottom here, we've got a story I can't get enough of. This is Telefónica Deutschland, down another 4%, fell 18% yesterday following news that Vodafone has got a new venture over in Germany. This is, of course, the O2 business operating in Germany, as the ticker O2D does signify. Now, that is a record two-day slump for that one. That also weighed on Telefonica in Madrid yesterday. That one fell as much as 7% and dragged down the entire Spanish index. Meanwhile, in terms of gainers, SES, this is a satellite company, got some positive earnings out today, some strong orders. According to them, they're based in France, the best performer over in Paris today, up around 10%. SocGen, quite surprisingly, actually positive, a 13% drop in their trading revenue, and also weakness in the French retail market, but that one potentially priced in. 15 analysts on the street recommend buying that stock, so that one is coming up slightly today. InBev as well, a big drop in Bud Light sales following the Dylan Mulvaney influencer saga that's weighed on Bud Light, a 28% drop in Bud Light sales in the US, but the emerging markets like Colombia and Vietnam doing pretty well and pushing the sales up in those parts of the world, helping that one. Finally, we've got Merck KGaA. This is the German business of Merck. There's two, obviously, one in the US, one in Germany. This one doing pretty well, given some of their life sciences drugs making up for a decline in COVID-related sales. Obviously, those sales now declining. They've also got a tech business, a semiconductor business, much smaller part of the company, but that one not as bad as expected, and that one is rising over in Frankfurt as well today, Danny.
Okay, Joe, there you go. Ending on a positive note. That's what we need with European stocks down more than 1%. Joe Easton from our equities team, thanks so much. Now, tech has really been under pressure, too. It also comes from the U.S. session, where the world's largest smartphone processor maker, Qualcomm, slid in the after-hours trade. It gave a tepid sales forecast for the current quarter. The market at the moment is contending with the worst slowdown in years. Joining us on this is Bloomberg Intelligence's tech analyst, Matt Bloxham. Matt, as if tech wasn't under enough pressure from higher yields, what were your key takeaways from Qualcomm?
Well, yeah, I mean, I'd say that smartphones is the big segment for Qualcomm, 60% of revenues, and also China also makes up 60% of the revenue. Those kind of mixed together. We saw smartphone revenue down 25% year on year, and the China recovery, everybody expected, just hasn't come through as strong as people thought. So they're expecting a continued soft smartphone market into the second half, which is really putting pressure on the overall business. Yeah, and the midpoint of their guidance for the next quarter, $8.5 billion of revenue. Consensus looking for about 8.9, so a bit, 8.8, so a bit soft there. And yeah, you know, I think that they've been trying to diversify for quite a while into autos and IoT. That's going well, but it's just not going quick enough to compensate for this continued pressure on the smartphone market. And at some point in the future, they're probably going to lose Apple as a contract as Apple shifts to its own silicon. So they've been flagging that again. You know, so there's kind of time pressure, if you like, for them to kind of get a bigger recovery from the Android market and from these other ventures.
That's a really interesting point, because while you were speaking, I just pulled up SPLC on Apple. Qualcomm right now is 7th in terms of top-ranked suppliers. So does that bode poorly for Apple or not, if they are starting to shift away? What does that tell us about what we're going to hear from them?
It's interesting, because obviously Apple report later today, and I think people on the margin hoping for them to be a little bit more optimistic about the kind of forward quarter, because obviously they've got the iPhone 15 launching, and there is, you know, some kind of optimism out there that maybe Apple's going to guide a bit more confidently than they have been so far about the outlook for that product. But we'll have to see. Maybe that optimism's a little bit misplaced given what we heard from Qualcomm today. But, you know, the economy is, you know, unpredictable. I think right now a lot of companies are just not really quite sure how to call the next kind of 6 months or so, because the signals in the economy are quite mixed.
What about Amazon? We're also going to get their earnings. What are expectations like?
Yeah, so I think the focus there is going to be on the cloud business, where the market's looking for about 10% growth year on year. That'll be a slowdown from 15% last quarter. I think the big question there is, what is the AI strategy for their cloud business? They've been a little bit behind the curve compared to, say, Microsoft. So I think people are looking for some stronger statements from them about how that's going to evolve and how it's going to support revenue growth into the midterm. And as with everything else, that kind of forward quarter revenue guidance is going to be really important. The market's looking for about $138 billion of revenue, which would be about 9% growth, so kind of keeping stable growth relative to this quarter they're about to report. So yeah, all eyes on cloud and AI and that forward guide on revenue.
Well, hopefully they can save the tech earnings season. Again, it's not been a good run here, maybe more for macro reasons, but again, some of the earnings not so strong, as you pointed out. Matt, thank you so much for joining us. That's Matt Bloxham from the Bloomberg Intelligence team. Coming up, more tech stories for you. Unfortunately, not good ones either. Infineon plunging this morning, now more than 12%. The German chip maker's outlook has missed estimates. We have the details for you next. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, Friday on Bloomberg Television and Radio.
Welcome back to Markets Today. 41 minutes into your trading session, and it's a second day of over 1% declines for this equity market in Europe. The overall index, it is down just about 1%. Large caps doing worse, down 1.2%. You break it up by regions, even uglier. It is a mix of just generally a sour sentiment and earnings and higher yields pressuring stocks too. Let me quickly show you what treasuries are doing, because this sell-off has continued again for a second day. After we saw a sell-off yesterday, it's happening in duration. In the long end of the curve, 30-year yields there higher by 8 basis points. We continue to see bear steepening on the curve. The curve at the moment is at its closest to zero since May. That move is continuing alongside with JGBs, which have made a round trip. Yields are under pressure again and are at the same level before the BOJ stepped in this morning. Now, as I mentioned, also contributing to the stock story, not just these yields, but earnings. Among that, the London Stock Exchange Group, those shares have also moved lower this morning. Signs there that growth faltered in the first half. Now, we spoke to CEO David Schwimmer earlier exclusively on Bloomberg Markets Today.
Top line growth, we have probably beaten estimates a bit. In terms of EPS, that might be a little bit off, but that's largely given the higher tax rate. So overall, the business is performing extremely well, and our strategy is working. This is a business that is very well positioned for the era that we are in now, which is an era of technological driven change. So lots of things going right in this business, and we're feeling very good about it.
Yeah, and look, you know, we can see a lot of this coming through from data and analytics in subscriptions. But David, when it comes to the IPO market, when do you expect it to come back?
Obviously, we've seen a pretty subdued IPO market around the world. And given what's been going on with war in Europe, with concerns about recession, with uncertainty about interest rates, frankly, that's not very surprising. We are seeing a healthy pipeline building up. The IPO market, it closes, it opens. You know, it's been cyclical pretty much forever. So I expect to see it opening up hard to tell exactly when, but we're starting to see some green shoots now. We've seen some successful offerings already a little more recently. So we'll see what happens in the second half, and optimistic about it coming back strong and healthy.
And LSE Group CEO David Schwimmer optimistic on coming back, but again, that market is trading down. That was, of course, an exclusive conversation with Mark and me on Markets Today. Okay, let's check in now on some of the biggest stories on the DAX, and not so great either. German corporates are the big drivers so far in the morning session, with the DAX down more than 1.2%. Let's get a roundup now from Bloomberg's Oliver Crook in Berlin. Oliver, one of the worst performers this morning, Infineon. Walk me through this reaction in the market.
Yeah, absolutely. We got the numbers out this morning, and it looked okay kind of from a revenue perspective, but really what investors seem to be drilling down on are margins. Margins came in a little bit softer in the second quarter, and when you throw it forward, it's looking softer still. You also had this announcement that they're going to spend 5 billion euros to invest in this fab in Malaysia. Again, that is going to touch, what kind of profits and revenues you can bring in the shorter term. The question is, investors wondering, maybe are you overextending yourself a little bit? So you had the biggest drop today since March of 2020. But, if you bought this when it did drop at the beginning of the pandemic, you've more than tripled your money. Let's not lose sight of that fact. You guys spoke to the Infineon CFO a little bit earlier today. Here's what he had to say about earnings.
We had a very, very strong third quarter. And now, based on the mega trends we are very much benefiting from, be it electrification, be it renewables, be it IoT or data center, we could continue to believe also in a strong finishing quarter, another 4 billion. So therefore, we are reconfirming all our formally communicated targets for the year: 16.2 billion revenues, 27% segment result. That would be a record year for Infineon. So all is laid out for a good finishing of the year. And as you mentioned already, of course, we are also thrilled to communicate today about the big expansion in Malaysia. I'm sure we will talk about that in a second.
Yes, Sven, indeed. I want to ask you on that. Why Malaysia? Is this about getting closer to your Chinese market?
Mark, I think in semiconductor, you have to, of course, balance a lot of different effects or factors. You make such a huge investment decision. And indeed, what we announced this morning, 30 minutes ago, is that we are doubling down on our silicon carbide-based manufacturing footprint. We already have big manufacturing operations in Malaysia, front end and back end. We will now invest up to 5 billion euros over the next years into a silicon carbide-based fab in Malaysia. Why is Malaysia a good place for us? We are in the country since a long time. There's a great base for employees. We already have a fab. You know that economies of scale matter a lot in our industry. So we expect to generate up to the end of the decade 7 billion euro of annual revenues in silicon carbide only. And this will then also benefit and support our 30% market share. And it's very important, this investment is backed by strong customer commitments.
So about a 10% decline there, Oliver, as you were laying out in response to those earnings. Adidas also got some results from them, too. I mean, the focus has really been on Yeezy sales, hasn't it? What did we learn?
Yeah, absolutely. Let me get through some of the numbers, and we'll touch on the Yeezy side of it. Their gross margin came in a bit better at 51%. Investors were expecting 49%. They have a massive inventory problem. This was highlighted by the CEO. They've got 5.5 billion euros worth of it. That is higher than what investors had been expecting. They're seeing some volatility and uncertainty in the outlook. And now onto Yeezy, the big question. They managed to move 400 million euros worth of Yeezy inventory, which was, basically these were seen as stranded assets that they could do nothing with earlier in the year. This was part of the strategy of the CEO, but now they're starting to sell it. They've dropped one batch in June. They're dropping another this week, and they're starting to move this. So this is good news because a lot of investors thought this was just lost money. However, this is the end of this, right? Once they've moved this inventory, that's it, and there's no more kind of Yeezy in the pipeline. The question is, are they going to be able to kind of rekindle that kind of brand heat elsewhere?
Okay, and finally, just to wrap things up, Oliver, BMW, we had their pre-announcement. We have more details this morning. It looks like the market didn't like the pre-announcement or the details.
Yeah, they do not. That is correct. So what we got, they did manage to raise their outlook on deliveries, and a lot of the numbers were actually basically in line in the pre-release. However, when you're looking into the future, and this is really what the investors were focusing on, it's all about the cost of developing EVs. So you look at their R&D figure for the second quarter, that was up 20%. And when you look also at CapEx, up 20% in the second quarter, and this is all down to costs of electrification, digitalization, all of this sort of new step, this marathon in changing over to EVs. However, and Rolls-Royce was also not delivering. Their sales were sort of flat year on year. I also noticed in the statement, because we've been watching this closely, that that Rolls-Royce said that they had a small number of cars on that ship that was burning off of the Netherlands. A small number of cars at 500,000 euros a pop, may be something that's worth noting. They're apparently telling the people who had ordered those cars and informing them about it. In the regions, I'll just say China up 16%, Europe up 9%, US up 14%. So that's the picture for BMW.
I literally can't imagine being that person that gets a phone call and says, sorry, we can't bring you your car because it's on fire in the middle of the ocean. Oliver,
Rolls-Royce,
thank you so much. Yeah, exactly. I mean, it only takes them like 5 years to hand make a new Rolls-Royce. Anyway, Oliver, thank you so much. Wrapping up all of the German corporate stories for us, Oliver Crook in Berlin. Okay, coming up, bonds still under pressure this morning. Duration sells off. Continuing to get a follow through, even though it's, we've known it for some time, the Treasury issuance announcement. We're going to have more on that next. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. Over 50 minutes into your European trading session, declines continue. Europe stock 600, now less than 1%, but still for most of these regional indices down more than 1%. Ugly earnings and a sell-off in bonds. Quickly, some eco news to bring you. We've just gotten France services PMIs coming in weaker than expected, still in contraction. 47.1 is where they've hit. The estimate was for 47.4. So a miss and still in contraction. Let me show you what treasuries are doing now, because the sell-off has continued into today's session after yesterday's session. Up above 4.1% across the curve. You're looking at the highest on the long end since November 2022, or at least the highest of this year. So there you go, long end up about 8 basis points. Joining us now to discuss this is our markets reporter, Valerie Teitel. Valerie, what do you make of this, the fact that the sell-off, it's not abating?
Look, I find the follow-through really surprising, Danny, especially because we knew a lot about what the Treasury was announcing this week, right? We know the deficit's soaring. We know tax receipts were disappointing. And the interest expense is climbing. Those are all things we knew. We knew they were likely to borrow more. I think what it's showing is that the market is very, very skittish at the moment to absorbing this extra supply. And we've had some commentators overnight, Bill Ackman being one of them, noting that they're short 30-year treasuries. And his reasoning is that he sees a big repricing in the long end that could happen in a matter of weeks. Now, I don't want to foreshadow too much, but we could have another kicker this afternoon. If the Bank of England announces a ramped up pace of QT, that could be just another pressure for this steepening move. And we could see yields, climb very close to those cycle highs in the Treasury market.
No, that's a really good point. There's another driver. We've seen it in the past where a reaction in UK bonds also pressure that of the global market. But I mean, could we harken back to the days when the UK bond market was plumbing new highs in reaction to the Liz Truss plan? Could we get that sort of thing in the US, just considering how skittish things are?
I don't want to tempt fate. I know it's a big comparison to make, but what happened during that Liz Truss event is very similar, right? The U.S. Treasury is approaching the market saying, we're going to issue some more bonds, we're going to borrow some more, and we're going to keep spending. And this is the reaction we're seeing in the Treasury market. It could just be that what ends the cycle is actually the bubble in government borrowing, this bubble in the Treasury market, where what could end the cycle could be a massive steepening of the long end of the U.S.
Okay, Valerie, thank you very much. Setting up for, I guess, exciting day. We have to look at the bright side here, Valerie. Valerie Teitel, our markets reporter. All right, we just had the final numbers come through for Germany's PMIs, for their services PMIs, coming in at 52.3. That's a slight upgrade from the initial figure that was 52. So that is in expansionary territory, whereas we heard France, those final numbers coming in slightly weaker than the initial figure. Here's your look at a euro, a weaker euro this morning. But again, all eyes are going to turn to not just this bond market, but I should say equity markets. It's another really difficult day. Will the sell-off accelerate into something worse? We haven't really seen that for a few months. We're really short vol at this time. Are we also just poorly positioned for what might be to come? FTSE 100, that underperforming, down 1.4%. A tough day for basic resources. Iron ore now below $100. That sold off by about 4%. Okay, that's it for markets today. The Pulse is up next on Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Decision day at the Bank of England. Will it be 25 or 50 basis point hike? We're live from Threadneedle Street. Now, the Bank of Japan steps in for the second time this week with more unscheduled bond buying to slow the spike in yields. Plus, coming up in our weekly UK show, the future of housing. Will there be a crash or just a correction? But first thing is first, because there's quite a lot going on in the markets. Now, when you look at the European map, they're definitely taking their cue from what's been going on overnight and, of course, what we're seeing in treasuries. You can see the FTSE down to 1.5%, pressure across the board with the CAC 40 down 1.3%. So stocks are definitely deepening their slump across the board, unraveling some of this year's high-powered rally. We have a great, of course, chart looking at that, but really everything stems from treasuries, and treasuries declining is adding to some of that nervousness out there. In the latest earnings news, we also want to show you Infineon. Infineon, I think, down 8% in today's trading session. This is after they really disappointed in terms of forecasts, and that came from the German chip maker. So you can see it was down 8%. It's now down 12%. Overall, of course, the picture is one of the rally that we saw in the stock 600, definitely erasing some of their gains from the start of the year. So if we look longer term at what we've seen European stock 600 do, you can see this is almost from, well, the start of July. And we were seeing a rally that we saw very much also in some of the European, the other U.S. indices. This is over the last 25 days, and we're seeing now a slump, not only because of earnings, but really because of the rout that we're seeing in treasuries. Now, investors bracing for another interest rate increase also from the Bank of England later today. So we're looking at gilts, U.S. 10-year, where we're seeing quite a lot of movement for 1.486. We'll go back and actually look in depth at what that means for treasuries going forward. There's a huge issuance also that's coming out in the next 10 days or so. Now, it's decision day for the Bank of England. Economists split on whether we'll get a 25 basis point hike or 50. For the details, let's get straight to Lizzie Burden on Threadneedle Street. So, Lizzie, what are we actually expecting in terms of the decision and the vote split?
Well, as you say, Francine, markets and economists are split on whether we're going to see 25 basis points or a 50 basis point hike from the Bank of England today, up from 5%, the current level. This after the cooler than expected inflation print in June encouraged traders to pare back their bets for where they see rates peaking here in the UK. Now they see 5.75%. You remember we also had that Bloomberg scoop revealing that a majority of the Chancellor's Economic Advisory Panel, some of them former Bank of England policymakers, are worried about the risk of the bank over-tightening. Be interesting to see in the updated forecasts today whether the bank sees a recession on the horizon for the UK economy. So in terms of the vote split, our economists at Bloomberg Economics reckon it's going to be 3-5-1, 3 for 50, 5 for 25 and 1 for a hold. And then in terms of the language around the decision, they reckon it'll be much like the ECB and the Fed, leaving the door open at the next meeting for a hike or a hold, whatever the data warrant. The other potential surprise, though, could be about quantitative tightening. The Deputy Governor, Dave Ramsden, signalled last month that we can expect an announcement in September about an acceleration of the pace of quantitative tightening because it's been going on like clockwork in the background. He wants to retool the arsenal in case of another crisis. But there has been speculation from Capital Economics and BNP Paribas that that announcement could come today because there is precedent for an announcement like that at the August meeting when they've got the opportunity at the press conference. I know you'll be there later, Francine, to explain themselves. But it didn't stop them going for a jumbo hike at the last meeting, so we'll have to see at 12 o'clock the decision from the Bank of England.
Yeah, and we'll see what they'll do, of course, with QT and whether that then gives them more ammunition or something to go wrong with the economy. Thank you so much. Our UK correspondent there, Lizzie Burden. Now, don't miss our coverage of the Bank of England's policy decision at midday UK time with a press conference 30 minutes later. Now, also, the Bank of Japan announced unscheduled debt purchase operations for a second time this week. So let's get straight to our Valerie Teitel from our markets team. So, Valerie, what are we seeing today?
A second intervention from the BOJ since their yield curve control tweak only last Friday. Now, we're slowly trying to understand the reaction function of the Bank of Japan, what prompts them to actually intervene. 2 times maybe doesn't make a trend, but if we look at what's prompted them the last 2 times, it was just over a 5 basis point rise in the yield. The last time they intervened was on Monday morning. That was right after the tweak. And then if we compare when that intervention was on Monday to where they intervened today, it was just over a 5 basis point rise that prompted them to intervene. Does that kind of trend hold? That will be the question the markets are asking. Now, we have seen some quite bizarre price action when it comes to dollar yen, so I want to talk about it for just a moment. This morning, when the Bank of Japan announced the intervention, we did see a original bout of yen weakening, because that makes sense. If the Bank of Japan doesn't want yields to rise, if it's preventing it from following the global trend, the pressure is released elsewhere. It's released in the FX market. But in only the last 30 minutes, we have seen a bout of strengthening in dollar yen. A lot of eyebrows raised on what triggered this, Francine. Now, remember, we are slightly on intervention watch from the Ministry of Finance. We know the last time they intervened to prevent the yen weakening, it was around the 144, 145 level. And on a 143 handle now, we're not very too far off from that trigger.
Valerie, thanks so much. Valerie Teitel there on the BOJ. Now, joining us is Chatham Financial Managing Partner and Head of Chatham Europe, Jackie Bowie, and Bloomberg's Christine Aquino. So thank you both for joining us. Jackie, when you look at BOE and what we're expecting, 25 or 50?
I think most people are firmly in the 25 basis point camp this time round, especially after 50 basis points in June, and since then we've seen some improvement in inflation data and some weakening in the economy. So firmly in 25.
Okay, firmly in 25. This is our big number. I love this. So we're starting to basically find a number, and we're trying to put it into context. And Christine, it's 33%. Basically, is our big number today, which means that there are 33 market participants that believe that actually they'll get 50 basis points from the BOE. So I don't know whether it's a communication problem with the BOE or just because data. Sure, core inflation has come down a bit, but we're still a bit all over the place.
Yeah, I think that's exactly right, Francine. I mean, that 33% camp, it's not the majority, but it's certainly a sizable minority, right? And could introduce quite a lot of volatility into the decision. And you're absolutely right. I mean, just looking at the level of inflation here, yes, the nominal rate of inflation has come down, but core still very much sticky. And both are just way above that 2% target for the Bank of England. So quite problematic still for policymakers. But again, we know that the dangers of the UK economy that the UK economy faces if they do in fact continue with jumbo rate hikes, 50 basis points continuously. And that is, of course, the risk that we do get a harder landing for UK economy further down the road, especially because the cost of living crisis is still very much an issue here.
Yeah, and you could also see, I guess, a situation, Jackie, where you have inflation coming down, core inflation coming down. I mean, it's still very high, but then it kind of picks up towards the winter months. And so I don't know whether, the Bank of England then has a credibility problem if they don't see that coming.
Yeah, and there's always the risk of some external shocks. I was reading yesterday that we think there's another El Nino event coming our way, which obviously impacts food pricing. I think the other part of it is what we've seen in the inflation numbers, which is more concerning for the Bank of England, is in that service sector. So the concern also about wage growth. So as we look at the data that might influence the decision, and perhaps for the September meeting and beyond, I think it will absolutely be in that service sector and the wage growth numbers. That's where the risk lies, to your point about inflation perhaps continuing to be materially above that target rate. The other part which we'll be looking for today is where the Bank of England's come out in terms of how quickly they think they can get back to the 2% target.
But also QT. I mean, they could. I mean, does it make sense for them to give themselves, a little bit more space by doing QT, maybe even quite aggressively, or announcing it, so that if something were to happen with the economy that doesn't go to plan, then they just have more of a bazooka?
Yeah, and there's been some interesting commentary about that even this morning, because the market is still predicting that interest rates are going to come back down at the end of next year. And I would say that's been the biggest shift in the last few months, where perhaps that peak rate has come down from the higher levels, but there's more of an expectation that interest rates will stay higher for longer. Now, if that's not the case and the economy does slow, the Bank of England will then be cutting rates in the face of quantitative tightening. So they're opposing forces. I mean, they did say they wouldn't say anything till September, but
we'll watch. Christina, and then the problem is that we're seeing huge treasury moves. So I don't know whether whatever they announced today also has to fly in the face of that.
Yeah, absolutely, Francine. And we know, of course, what's driving the Treasury turmoil still very much reeling from what we're seeing just globally, right, with the Fitch rating cut for the U.S. And so, of course, feeding into the markets in the U.K. as well. So, yeah, quite interesting moves in bond markets generally. I mean, we are seeing that kind of more of a bear steepening trend, higher yields on the long end, which is exactly, I think, what policymakers are kind of worried about, is really those longer-term borrowing costs rising certainly creates a problem for a lot of governments now potentially struggling to pay their debts, not necessarily, running the risk of a default, but definitely struggling with higher borrowing costs for that borrowing that, they've launched a decade ago over low rates.
Christine, thank you so much. We'll be back with Christina Kino and, of course, Chatham Financials and Jackie Bowie as well. We'll have plenty more, of course, on the markets. This is Bloomberg.
Is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful, because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back. Still with us, Bloomberg's Christina Kino and Chatham Financial Managing Partner and Head of Chatham Europe, Jackie Bowie. Now, Christine, when you look at, there's a huge market movement, right? There's huge market events actually at the moment. How difficult is it to call it bottom?
Very difficult, Francine. I mean, we are already seeing that sentiment hit, right? We're nearly erased the gain for the year for both the SOX 600 Europe and also the FTSE 100, which we're watching closely on the Markets Today blog. And so I think there's definitely this sense of maybe the incredible run that we've seen in equities in the first half of the year, this is finally when it starts to roll over, because you are seeing these risks coming to fore, and they're coming to fore at a time when volumes are incredibly strong. So there's high conviction moves in this decline in equities at the moment.
Jackie, in general, I mean, when you look at, either economics, fundamentals, PMIs, or earnings, what's Europe's sentiment like?
I'd say that it's been pretty positive in spite of everything we've seen, but it does feel that the turn is coming. We've seen some earnings coming out of the construction sector. We've seen some of the data indices starting to show some weakness. So I feel it will be a more difficult fourth quarter in terms of sentiment.
And Christina, overall, what did we learn from earnings? I mean, a lot of them beat, but actually, some of them got slammed.
Yeah, absolutely, Francine. I mean, I think what we've seen is that there's definitely a high bar for companies to impress, especially at this point. We know, of course, that for banks, for instance, that benefit of higher interest rates possibly starting to fade. That's why we've seen these big buybacks for banks to kind of, sweeten it for investors while the good times last. Also a big theme, buybacks for big oil companies. Again, we know that fade in energy prices very much factoring into their profits right now, so they're kind of adding that as a sugar pill for investors, give them a little something, even if energy prices are down from their peak.
All right, thank you both for joining us. And a terrific roundup of the markets. Christina Kino from Bloomberg and Chatham Financial Managing Partner Jackie Bowie. So I mispronounced both the first and the last name, Jackie. So no one's jealous. Coming up, French utility Veolia reports a first half profit rise on strong demand from Europe to the Americas. Don't miss our exclusive interview with the Chief Executive Officer, Estelle Brachlianoff. That's coming up next, and this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back. Now, Veolia said first half profit jumped 20% as the French utility benefited from strong demand in the U.S., Latin America, and Eastern Europe, as well as deeper than expected cost cuts. Well, joining us now is the Chief Executive, Estelle Brachlianoff. Thank you so much for joining us. First of all, you've had a good set of results with first half profit actually jumping some 20%. Was that mainly on cost cuts, or do you think the economy held up better than you thought it would?
You're right, it's a very good set of results and another all-time high for Veolia with plus 14% of revenue and 90% as net income growth. So very happy about that. And this is mainly due, of course, we are going on with our cost cuts, but this is mainly due to the very, very good demand of our services. You know, we are unique positioning in leader of ecological transformation, meaning we're helping our customer, cities and industries to decarbonize, to depollute, to regenerate resource. And you can imagine in the world we live today, that this demand is, you know, higher and higher every quarter. And this is what we enjoy. Plus, of course, a good track record of delivery, cost cutting, and synergies with the merger with Suez.
So what are you expecting in the second half? When you look at, of course, some of your units tied to manufacturing, industrial waste treatment, plastic and metal recycling, do you think it'll get better or easier given the economic cycle?
I'm very confident for the rest of the year. This is why I've this morning raised our guidance to now target the upper range of our 5 to 7% EBITDA growth for the year. And how is it so? Because we are 85% immune to economic industrial growth in Veolia, thanks to a very geographically spread footprint. Just to give you an idea, we have a $5 billion turnover in the US alone, and 40% of our turnover is outside Europe, and a very good mix as well of activities, wastewater and energy. So very confident for the rest of the year, and if I may say, for the years to come.
So when are you expecting, or what are you expecting to be your main growth drivers actually going forward? Again, given the headwinds that we're seeing, is it really some of these units that will bring you forward, or is there anything new in the pipeline?
So just to give you a few illustrations of this, I would say, incoming calls for services. In water technologies, water treatment technologies, where we are the worldwide leader with a lot of patent and a wonderful portfolio of technologies. We've enjoyed bookings of 2.7 billion in just the first half of the year. This is with industrial customers present in the lithium factories, in gigafactories, in chip manufacturing, as well as mining, for instance. So this is just one example. Another one will be hazardous waste, where again, we're #1 worldwide. And we've enjoyed a wonderful set of results, in particular in the US, in the first half of the year, and I anticipate that to go on.
Estelle, your share price at the moment, despite some of the encouraging results, is down 3%. Do you worry that there are external headwinds that actually, you know, will weigh on Veolia going forward, that you can't control, that will depress your share price?
I guess I tend not to comment on the share price of the day, and to have a look at the share price over the mid-long term. And if you ask me, is Veolia share price undervalued? The answer is yes, obviously, in many ways. You know, we've enjoyed another great set of results, despite, you know, for instance, flat volumes of waste in the first half of the year. So in a way, we're disconnected mainly, 85%, to what the macro is saying. So there is no rationale behind any share price being down today at all. And again, very confident for the rest of the year and for the years to come.
Do you see any opportunities for Veolia to actually benefit from the US Inflation Reduction Act?
The Inflation Reduction Act is a very good example of a potential series of opportunities for Veolia. As I say, we're helping our customer to decarbonize or to regenerate resource, say circular economy, and this is exactly what IRA is supporting. So that's why we've enjoyed a very big growth in the US, and I expect this to go on for the years to come. Already 5 billion in the US, but fast growing for us.
Is there anything that actually the UK could do to attract, you know, more green investment?
I guess the UK has an ability to attract investment, and as you know, the key paramount is stability in terms of the legislation, and this is what can be done to help attracting more investment. But we're already very present in the UK and still investing a lot. So very happy about the business, which has grown quite well in the first half of the year, as much as other countries.
We also spoke to analysts and investors who consider basically the acquisition and the integration of Suez International as a success. What does it mean for what you want to do next? Is there more M&A in the pipeline, or will you have to sell off certain assets before you do anything else?
So you're right, the integration of Suez, which we acquired less than 18 months ago, is already a large success and bearing fruits. Just to give you an idea, 231 million of cost synergies delivered already in the 17 months since day one. So I'm super happy about that. We are well ahead of plan and on target. There is more to come because, of course, we'll deliver the cost synergies. But the revenue synergies is what interests me as well. And we have many opportunities to develop, for instance, treatment of new pollutant in water or wastewater reuse. And if you look at this summer in the world, where there is a lot of discussion about water scarcity and water quality, you can imagine that being the #1 leader of those type of activities gives me a lot of confidence that there will be even more to come. And we've announced a lot of good new contracts signed exactly in the first half. So do we need M&A to grow? The answer is no. We are going on with tuck-ins and bolt-on acquisitions.
Estelle Brachlianoff, thank you so much for joining us. That was, of course, the Veolia Chief Executive Officer.
On the product may read made in the USA, but the sign on the CEO's door often says made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate while this is a 3.
As the economic picture down.
The BOK is getting ready to make
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, the UK's sticky inflation and cost of living crisis has sharpened the focus on property prices. With the Bank of England's rate decision looming today, we take a much closer look at where the housing market may be heading. Now, the latest figures from Nationwide, one of Britain's largest mortgage lenders, show property prices fell in July at their fastest pace since the global financial crisis for the third month in a row. Now, however, things seem to be improving in terms of mortgage approvals, which increased in June, albeit still below normal levels. Now, key to this are the 13 rate hikes from the Bank of England. Mortgage rates are now above the levels last seen in November when there was turmoil in the UK debt market. The share prices of UK home builders have had a good month, boosted by Britain's inflation rate dropping to its lowest level in 15 months. Taylor Wimpey says home prices have stayed resilient. Now, Bloomberg Economics has a less positive outlook. It says that the housing market remains overvalued and there's a 16% gap between the price of a house and what the fundamentals can actually justify. So let's discuss all of this with Bloomberg's John Sepik and Raj Shah from Bloomberg Economics. Thank you both for joining us. I'm looking forward to our robust conversation on UK housing. So, Niraj, is the UK housing market going to crash? Dun, dun, dun.
It's not going to crash.
Okay.
Well, we expect it as more of a slow puncture than a crash. And we are expecting house prices to fall by 10% from last year's peak, but that's not a crash. For a crash to really happen, you'd need to see a surge in unemployment. So there's a forced sales going on from possessions, credit crunch. All of that we see is highly unlikely at this stage. We see unemployment rising to sort of 5% next year, so that's still historically low. And so essentially adjustment rather than a big crash.
Yeah, and I mean, I said it tongue-in-cheek, but the problem is that the UK is so reliant, John, right, on mortgages. If mortgages go any higher, are we going to have a problem? So maybe not a crash, but a kind of crash-like event.
I like that. I like the way you put that, Francine. Look, I think the thing is, like, mortgages, if mortgage rates do go much higher, then yeah, that would almost certainly become a problem, because you can see that people are already stretching themselves quite far. I do think, you know, one thing that's important to point out about the mortgage approvals data is that Q2 is usually the kind of high point for mortgage approvals each year. So this is the kind of strongest data in terms of seasonality. The third quarter is usually much more, you know, kind of calmer. And having a wee look at Taylor Wimpey's results, their reservations per unit have gone down as a result of that. So I think that, you know, we are moving into the part of the year which is traditionally calmer for the housing market. And also the latest nationwide figures don't quite take account of the impact of the most recent sort of tick up and down in mortgage rates. So I think we've still got pressure to come. But overall, I mean, I'd agree with Niraj that it's a kind of slow puncture environment rather than a crash so far.
So far, but I mean, this is the problem, right? So far, and you're still expecting a 10% fall in house prices from last year's peak, which is not insignificant. So again, what are some of the problems that this could entice? And you know, I guess what prevents a bigger drop is, as you said, unemployment for the moment. You know, is not falling off a cliff. But could there be an event that kind of triggers a bigger house drop?
There could always be, and that's why we always say there's an upside and downside risk. Yeah. But the one big thing is that a lot of people are still on fixed rate mortgages. We've had a historically high number of above 90%, and it's Bank of England don't expect the full impact of their rate hikes to come through. Only 2/3 of it's yet to come through, and that's only going to come through fully until 2026. So that gives a huge amount of time for people to adapt and adjust. So we never say never. There could be an adjustment, but I think one thing to keep in mind is a historical perspective.
Yes, which we have a chart, Niraj, so hold that thought. Let's bring the chart up, and basically, you know, how do things compare with the 1990s recession, and how do they compare to the financial crisis?
So, well, if we can actually go back even further than this, so if you go back the last 100 years, house prices have never fallen by more than 20% in one go. So that's one thing to keep in mind. You've had the 30s, Great Depression, the 1950s, where you saw significant declines, and then, as you said, the 90s and the Great Financial Crisis. I think the most similarities are with the 90s, where you had a huge spike in interest rates, causing house prices to fall. But at that time, you also had a surge in unemployment.
Yep.
So in some ways, this is actually more similar to the 1950s, where all of a sudden you had, during the war, rates at that time a record low of 2%, all of a sudden doubling overnight in the 50s, causing a housing crash. The one caveat there was there's also a big increase in supply, where people started building lots of homes. There's a lot of homes coming on the market as well. So that was one caveat there.
Yeah, and I guess also, if you look back in the 1950s, they didn't have to contend with like a fallout in treasuries. I mean, I know we're talking about shorter term, but it feels like the world is much more complex, right, than 70 years ago.
Well, definitely. I mean, there's lots more linkages between markets. I mean, the thing is, look, I do think it kind of comes back to this thing of the wider economy. It's if we get a recession, which is I mean, that's the thing that hasn't happened. I mean, if you think back to this time last year, everyone was thoroughly expecting that the kind of country was going to essentially fall off the edge of the cliff.
Implode, yeah.
Yeah, and it didn't. It's done very far from it. As long as we get this kind of adjustment whereby inflation is just high enough but not too high, and employment stays okay, then we can probably get by nicely, because you'll get real house prices will come down, so affordability will improve, because affordability is a massive problem. But at the same time, you won't get negative equity, and you won't get the banks kind of panicking because all of their assets are underwater. But obviously that sort of depends. It's a bit of a tightrope walk, because we don't know what's going to happen coming up. The Bank of England is hopefully going to be able to say that, okay, rates have just about peaked now, but inflation could rebound next year. The base effects are going to start falling out. Well, actually, in the US, they're going to start falling out probably with the next inflation reading. Over here, we're a bit further behind than that. But I don't. My personal view is we won't see inflation getting back down to 2%, quite possibly throughout 2024. And then you have to start asking, well, will that increase the odds that the Bank of England makes an even bigger policy mistake than it already has?
But John, and I have to say, I know you always, I always gush about your Money Distilled newsletter, because you never panic, right? But you're always thoughtful, and it's kind of always with this edge of like, watch out, because this could happen. And you basically wrote that, your last one was an uneasy column in the UK housing market. You talk about mortgage approvals. Yeah. I mean, how can we be sure that actually mortgage approvals, they've perked up and continue on that trajectory?
Well, you're right, they may not. I mean, I do think that is important. We talk about how the housing market hasn't crashed. Actually, it has sort of crashed because activity in the housing market has collapsed. Yeah. Approvals are running at 55 just now. The kind of 20-year average is 70. But the point is, again, as I said, this is one of the hottest months. Sorry, last month was one of typically the most busy months for estate agents, and now you're going into the summer lull. So, if we've kind of got a standoff, and again, this comes down to the fact there are no forced sellers. So people don't have to sell their homes, and they're not willing to sell them at the prices that buyers can afford or are willing to pay. Typically, you would sort of expect, eventually that to resolve one way or the other. Probably in the favour of the buyers, I would have thought. But it just depends on what the underlying economy is doing.
And Niraj, I guess, the Bank of England said to hike again today. Open call on whether it's 25, 50. I mean, most people say 25, but it could be 50. And how does it impact mortgage rates, also given that banks were taken at number 10 for not passing on savings? So I don't know whether that makes them more likely to be more generous with mortgages.
Well, on interest rates, it's a very close call. I mean, we were expecting a 25 basis point hike today to 5.25%, but it is a close call. If they go by 50 basis points, and I think a lot of lenders are actually holding out to see what happens today before they pass on some lower mortgage rates. So if they do go by 50, that might change things in terms of how expensive mortgage rates are. The one thing on the chart was that, and John, you've highlighted this, that literally, although quoted rates are quite high, 5.5%, and but the actual impact on the average on people is still below 3%. Mm-hmm. That big gap is quite significant. It's never been that high, actually. So that's something that shows that the pressure is still to come.
Yeah, but banks are under pressure, right? Are they under pressure to help mortgage holders?
I mean, yeah, I mean, there's the charter that they've signed, which basically just enshrines stuff they'd already agreed to do. I mean, your average bank doesn't really want to repossess someone's house because, frankly, it's a hassle. But also, they're still paying, quite rightly, for, 2008 in terms of their reputations. So I don't think, unless something drastic happened, I don't see kind of repossessions becoming a big deal. I think they're more under pressure on the savings side at the moment because that's been the thing that's in the papers. And that means, the risk is their net interest margins get compressed because they're busy trying to hand on interest rates to savers and at the same time trying to be careful with their mortgage customers. I mean, also not writing as much mortgage business. So, I mean, but, you know, at the end of the day, banks' balance sheets are pretty healthy, so it's not, I don't see it causing a major problem.
All right, thank you both for joining us. John Stepek there and Niraj Shah with a thorough look actually at the mortgage markets and what we could expect from the Bank of England. You can also read more from John in his free daily newsletter. I didn't know it was free. It's free daily newsletter, Money Distilled. Sign up at bloomberg.com/UK. Coming up, we'll be joined by Camilla Dell from Black Brick and Ray Bolger from John Charcoal as we continue our deep dive into the UK's property market. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, Friday on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, we continue our deep dive into what's next for the UK property market. And we're now joined by Camilla Dell, founder and managing partner at Black Brick, and Ray Bolger, senior mortgage technical manager at John Charcoal. So I'm delighted to have you both to have a look, first of all, at some of, I guess, the high-end property market, exactly who's buying what, and also more of the technical side of mortgages and who's managing to get approvals. So Camilla, let's start with you. What are you seeing in terms of trends that maybe are surprising compared to either a year ago or 2 years ago?
Yeah, I think it's interesting because when you look at your previous guests and listen to what's happening in the wider UK market, property-wise, it all sounds really negative, very doom and gloom. And I think it's important to distinguish London from the rest of the UK. It is a very, very different market, driven by very different factors. And when you look at, whether we're seeing prices reduce and coming down in central London? Not really is the answer. Prices have come down 0.2% this quarter across London, and over the last year, they're down just by 1%. So I think it's really important when you're listening to sort of the wider picture of what's happening in the UK housing market to remember that London is really driven by quite different factors.
But I mean, is this London in general? Is it higher end? Higher end? Because I know in your notes you also say that there's a lot of people that want flats, and that's been one of the main drivers.
Yeah.
But they also have a lot of cash, so this is maybe not a normal UK worker.
Yeah, absolutely. I think when you look at London, you've got to look at the different parts of the market. Clearly, the more debt-driven parts of the market in London are not doing as well as the higher end. In our own data, what we're seeing is a shift towards our clients taking finance to buying purely in cash. So far this year, 57% of our clients have decided not to take finance and to buy in cash. And when you look when you really drill down and look what's happening in the market, the market above 3 million and above 10 million is faring quite well. Conversely to that, the market between £500,000 and £1 million, as you might expect, is not doing as well, and there has been price decline there.
So, Ray, give us a little bit of your insight into what people want in terms of mortgages. I know you say, for example, tracker mortgages currently look better value than 2-year fixes. Does that, how often, or when did that change?
Well, you say better value, it's cheaper, but that doesn't mean it's better value. I think at the moment, because there's about a 0.5% gap between the cost of 2-year fixes and 5-year fixes, but you can actually get a tracker mortgage that's significantly cheaper. And even if bank rate goes up by another 0.5 point, the best tracker mortgages will still be cheaper than the best 2-year fixes. So I think whereas until fairly recently, the choice for mortgage customers has been, should I fix for 2 years or longer? Now, actually, the question is, should I take a tracker or a fixed rate? But I don't think 2-year fixed rates actually have much value. I think if you're going to go for a fixed rate, you may as well go for something longer if you need that security of knowing what your payments are going to be. Plus the fact that because of the way lender stress tests work, in some cases, if people are stretching their budget, they will find they can borrow more if they choose a 5 or 10-year fixed rate than if they choose a tracker. So for some people, that might be a key factor.
So what's your best piece of advice right now for someone who's either new to the property market or needs to look for a bigger place?
Well, one of the questions, of course, is now a good time to buy? And I mean, Camilla will, I suspect, have a similar view to me on this. I think the right time to buy is when actually it suits your personal circumstances. I mean, if, for example, you're a first-time buyer, then if you expect prices to fall over the next year or so, which I do, but I don't expect them to fall dramatically, and you've got to weigh up the benefit of having your own property, having security of tenure, compared with perhaps paying rent for another year or so. And when prices are falling, then it's a buyer's market, of course, and it means you're in a much better place to negotiate a good deal. So the time to buy is actually before prices have bottomed out, not to wait until that happens, and then you're in competition with lots of other people. If you're moving home, then of course it swings and roundabouts. And I think the biggest challenge at the moment for a lot of people is going to be making sure whatever chain they're in, assuming they're in one, actually doesn't break down, because when the market's slow, it clearly becomes much more problematic to replace somebody who drops out of a chain. But basically, if you're buying a property, I think you need to negotiate hard. Bear in mind the market is very different to even 6 months ago, and you are in a buyer's market.
Yeah, and Camilla, how big is the mismatch between, I guess, the prices that owners want to sell at and buyers want to buy at?
Yeah, I think, we see on a case-by-case basis very, very different scenarios, and each negotiation that we handle as a business is specific to that particular deal and that seller's circumstances. Average savings for us as a business are about 4% over the last 12 months. So, yes, it is a buyer's market. I think buyers, particularly in the prime markets, also need to be quite mindful of the fact that not every seller in prime central London needs to sell. And I saw a recent report that suggests only a third of homeowners in London actually have a mortgage. So whatever happens with interest rates today, there's a lot of homeowners in London that quite frankly are not being affected by rising cost of debt. So you've got to remember that. I agree with Ray in that I think if you're buying a home at the moment and you're waiting for prices to fall, yes, that's a factor, but I think the most important factor is, can you find the right property? Traditionally in prime central London, there has been a supply-demand imbalance. We are continuing to see that at the moment. And in fact, on some of the transactions we're doing, our clients are having to compete, even now, even in today's market, and pay sometimes over the asking price to get the property that they want.
Camilla, a third of people in London not having a mortgage is a huge number. Is that because they've had the property for a long time?
I think it's a combination of having the property for a long time, but also just paying off their mortgages and the sheer volume of cash buyers that we see in the market as well.
Okay, our conversation, of course, on the UK property continues. Camilla Dell from Blackbrick and Ray Bulger from John Charcoal Mortgages. Stay with us. That's coming up shortly. And this is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back, everyone, as we discuss what's next for the UK property market. Still with us, Camilla Dell, founder and managing partner at Blackbrick, and Ray Bulger, he's senior mortgage technical manager at John Charcoal. So, Ray, let me actually go to you first. When you look at mortgages, I know you've given some good advice to negotiate hard, but also move and size up when you have to, which is just in general good life advice. Is there something that you worry about people overstretching, thinking that their jobs are safe? And this, I guess, is a great unknown in the economy, because there's a tight labor market. The economy is fine until it's not.
I don't think most people are going to be worried about their jobs, but if they are, they're not likely to be looking to move house. And of course, people who've got mortgages now will in the main have been stress tested for rates of around 7% or so. So in theory, most people should be able to afford even these higher rates. Obviously, other factors will have influenced things in the meantime, so it's not that simple. But I think one of the interesting stats, I think, which gives you an idea as to why house prices have to fall further is that although, as Camilla said, a higher proportion of people are now buying for cash, I think that's probably truer in London and elsewhere in the country. It's always people at the margin that actually affect prices. And if you compare how much somebody could have borrowed when mortgage rates were, say, 1.5% a couple of years ago, and what they will be able to borrow now, or perhaps in the future. Now, I'm thinking mortgage rates will be back down to 4% within a year or so. Even at 4%, your borrowing capacity is about 20% less given the same mortgage term as when rates are 1.5%. Because people can afford is such a key factor in what they're prepared to pay for a house. That's why I think we're going to continue to see house prices drift lower for the next year or so.
Yeah. So, Camilla, what are your clients asking right now?
Is it the right time to buy?
Yeah.
What is supply like?
Are they shy in spending too much? Or are they trying to, if not downside, just being a bit more careful?
Yeah, we've seen some price adjustments, some budget adjustments with some of our clients who are borrowing and, just looking at how their costs have risen and having to adjust their budgets accordingly. So we've definitely seen that. I think clients are definitely cautious at the moment. They're not just gung-ho going out there and just spending at a whim. They're definitely much more considered purchases. They're taking their time to really make sure that they're finding the right property and that the price is at a level that is acceptable to them. And, so we're seeing that our transactions, the length of time it takes us now to actually bring a client to finding the right home and seeing that through is taking much, much longer at the moment, I would say.
All right, so interesting. Thank you both for joining us. Ray Bolger, Senior Mortgage Technical Manager at John Charcoal, and Camilla Dell here with me in the studio, founder and managing partner at Black Brick. Don't miss our coverage of the Bank of England's policy decision. That's at midday. The press conference is 30 minutes afterwards, and don't miss our interview with the Governor, Andrew Bailey. That's at 4 p.m. UK time. Of course, terminal users can follow all of the action of the commentary from Bloomberg's expert editors. That's at TLive Go. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
A second time here. Well, Danny, I've also had my eye on the super peso and, of course, the emerging markets, the Mexican peso, the Brazilian real as well. So I decided to bring our carry trade to the front and center. The Mexican peso versus the Japanese yen, which right now is kind of doing the exact opposite it's been doing for the past couple of months here. So essentially that carry trade on the back foot this morning, down by about 1.7%, essentially on the idea that even Brazil, which is looking to essentially guarantee another 50 basis points, Mexico, which may follow that lead, isn't necessarily having as much success as perhaps they thought they would.
All right, she's getting exotic with the currency pairs. I love it, Critty. I'm a little bit more basic here because the sell-off is accelerating in European equities. We've gotten some bad earnings, Infineon being one of them, LSE being another, but overall the sentiment is dour for equities for a second day, not necessarily just earnings driven. It does seem to be the global sentiment this morning. European stocks down about 1% on the headline index. FTSE 100, that's the underperformer today, down 1.4%. Some of the metal companies getting hit hard. Iron ore dropping as much as 4% this morning, back below $100. And Critty, I did want to just point out that move away from duration, that sell-off it's really taken a global move. The 30-year yield in the UK is what's moving the most, not as much as we're seeing in the US, but still a move nonetheless, 5.5 basis points. If you look at the front end or even in the belly of the curve in the UK, you're not seeing that much of a move despite the fact we have that BOE decision. Kriti, not only is it interesting from a macroeconomic point of view, as you were pointing out, with sticky inflation, but just because of this bond market. We've seen before the UK bond market bully the entirety of the bond market and bully treasuries. If we get a surprise to the upside, if we get more hawkish speak, it could certainly make a difference with the treasury market too.
Yeah, a lot to digest there, and I think that's really where we're going to see a lot more of the volatility. To me, what's going to be interesting is the dynamic between the stock and bond market when you're kind of seeing a sell-off in both this morning, Danny. Of course, the move, what's really started this whole thing, came down to Fitch Ratings' downgrade of U.S. government credit, put a renewed focus on the nation's debt trajectory. Richard Francis, Fitch's co-head of America's sovereign ratings, well, he was on Bloomberg Television yesterday speaking about the action.
AA plus is the second highest rating we have. It's not a low rating. It's not, it's still a very high rating. It just we're just saying that we do not think that the underlying fiscal story and the governance is compatible with AAA anymore.
Joining us now is Bloomberg's Valerie Teitel. Valerie, we've seen a lot of maybe pushback, I want to say, about this ratings downgrade, not just from the likes of Janet Yellen, but also a lot of folks on Wall Street, even Jamie Dimon, saying it doesn't really make a ton of sense. Walk us through just the take and the kind of the day two fallout of what we've heard.
Well, it seems like maybe on day two, Kriti, people are thinking that maybe Fitch said something right. We did hear from both former U.S. Treasury secretaries, both Paulson and Geithner, kind of commenting that they agree on Fitch's warning. Paulson said that our fiscal trajectory is concerning. And then we also heard from Geithner. He said, you want to move the system to act before it's too late and too hard to fix. So both of them kind of urging some action on the trajectory of spending of the United States government, but let's see if that kind of pressure makes its way to politicians.
It's a perfect storm because you have this concern about the debt. Again, not just Fitch's downgrade, but in terms of this treasury supply coming to market. And it does seem like at a time where people are now looking at duration and saying, okay, here's a clear mispricing.
Definitely. I mean, the last few days, what we've seen in the long end, this steepening move that we've seen, I think has caught a lot off guard. Long end treasuries, the 30-year yield has moved 25 basis points this week. We're just 15 basis points away from cycle highs that we saw last year. And we had Bill Ackman, of course, throwing his hat into the ring, offering his commentary. He was out on Twitter, on X, shall I say, saying that he is short the 30-year treasury. He expects more increases of long-end supply on the way, saying that there are many times in history where the bond market reprices the long end of a curve in the matter of weeks, and it seems like now is one of those times. That's why we are short the 30-year treasury in size.
Yeah, Dario Perkins from TS Lombard responding to that, also saying we don't even need inflation at 3%. We just need something that's a little bit more persistent. Valerie, tell me what that means, this duration sell-off we've seen for this global bond market, because the BOJ stepped in again this morning.
They did step into today to intervene again. Another 5 basis point move seems to be what triggered them. But a lot of this is what's going on is really not good for the bond market. The BOJ lifting that anchor, the last anchor of keeping yields lower. We're also seeing the U.S. economy running very well. Government spending hold up. All these pressures going on in the bond market really causing this steepening to extend. And Danny, we could get another kicker this afternoon in just a matter of hours. If we do get a surprise announcement from the Bank of England that they are ramping up the pace of QT, that could really add to this bear steepening move, and it could maybe get ugly.
Bloomberg's Valerie Teitel walking us through those moves. These next few weeks are going to get really interesting. And of course, for more on that, let's bring in the worsening global profile of safe debt. We need that conversation. Bloomberg cross-asset reporter Denitsa Sikova is all over it. Denitsa, talk to us about exactly what Valerie was just mentioning. If we're positioned for a lot of this pressure, where do we go from here? What do traders do?
Yeah, I mean, so we kind of took a step back and we wanted to see how does that downgrade look with the historical trends. And it's kind of what we've seen for a very long time. It's something we've seen in corporate debt. It's something we've seen
in sovereign debt. Obviously, the US sovereign market is huge, but there are only 9 countries left with a AAA rating from all 3 agencies, which kind of 2 decades ago was a very common status to have across developed economies. Of course, we're kind of seeing a very similar trend in corporates. Like it was very common, it was a lot more common for companies to have that AAA status. For example, in 1980, there were like 60 companies that had that gold-plated status, and now there are actually 2 that have it from all 3 agencies. It's Microsoft and Johnson & Johnson. So there is like a wider trend that raises the questions of first, is AA kind of becoming the new AAA, or is it more that people, and especially investors who are like rating sensitive, will go into those small markets? I have preference for them. Of course, it's important that this is a long trend. Canada, UK have been downgraded, so a lot of funds are not so sensitive and have adjusted their constraints.
It's interesting, Denitsa, how this conversation, it's not anything new, but it's been enough to upset the apple cart. It's enough to have markets sell off. I mean, you look at just the bad timing of this. Just let's focus on the sell side. Mike Wilson saying he was wrong in the past few days about a more steep sell-off. Citi raising their year-end target. Stolfus at OPCO raising to a street high for the S&P year-end target. How poorly positioned is this market right now if things were to turn more ugly?
Yeah, I mean, people have been warning about it for a very long time. Things moved very fast, positioning moved extremely fast. If we look at stock buying, there is a Deutsche Bank metric saying it was the fastest pace, similar to the release of the vaccine in December 2020. Another big trend that kind of was overpowering in 2022 was people were hedged, they were defensively positioned. Now there was so little demand for hedging, people were moving away from cash. So it kind of made sense with things moving fast, with little protection on the downside. The big winners of the last few weeks, unprofitable tech and all those kind of riskier corners, saw some of the sharpest and biggest losses this year. So it's kind of a reversal of the sharp, risky moves we saw in the last couple of weeks and months.
Yeah, I mean, again, it's going to be fascinating to see if this sell-off worsens today, if you do get some of that positioning unwind even further. Denitsa, thanks so much. That's Denitsa Tsetsakova from our cross-asset team. Okay, here in the UK, as Valerie was mentioning, as we all have been mentioning, a BOE rate decision is going to be coming in about 2 hours. Now, another increase, which is what's expected, would make it the bank's 14th consecutive rate hike. Standing outside the Bank of England on Threadneedle Street is our Bloomberg UK correspondent, Lizzie Burden. Lizzie, this market, it seems firmly split on whether we go 25 or 50.
That's exactly right, Danny. And part of the reason, the big reason, is, of course, that cooler than expected June inflation reading. Traders off the back of that pared back their bets for where they see UK rates peaking. They now see 5.75% or thereabouts. But we had this Bloomberg scoop revealing that a majority of the Chancellor's economic advisors, some of whom, of course, are ex-Bank of England, are worried about the risk that the bank over-tightens. It'll be interesting to see whether the bank, in its updated updated forecast today, factors in a recession for the UK economy. That's the reason that some on the MPC wouldn't want to go for another jumbo hike, doubling down on the last meeting. You can tell from everything I've just told you, Danny, it's very confused going into this meeting, and that's why Bloomberg Economics reckons you might get a three-way split today. 3 going for 50, 5 going for 25, and 1 going for a hold. It would be, I think, the first three-way split since December, so one to watch out for there. And in terms of the language around the decision, probably likely to echo the ECB and the Fed in the sense of leaving the door open to a hike or a hold at the next meeting, all depending on the data.
Well, this is why exciting. Literally, either way they go, 25 or 50, it will be a surprise. Lizzie, thank you so much. Lizzie Burden, outside the Bank of England. Stay tuned for our special coverage of that central bank decision at 7 a.m. Eastern Time. And later this hour, we're going to get more insight on the BOE. We'll be speaking with HSBC senior economist Liz Martins. But first, up next, we got to talk tech because giants Apple and Amazon are getting ready to take the spotlight. We'll give you a preview of those results. Plus, look at some of the big earnings stories on Europe happening here. That includes SocGen, Infineon, and as Critty would say, Adidas? Adidas? I can't even remember how you're supposed to say it anymore. We'll get to the bottom of it next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Earnings season, we are in the thick of it. Qualcomm, they gave a weak forecast. Then we got Apple and Amazon coming out today after the U.S. market closed. A lot to dig through. Joining us to do that is Matt Bloxson of Bloomberg Intelligence. Matt, let's start with Qualcomm. What were your key takeaways there?
Yeah, so as you said, like a weak forecast for the coming quarter, so they guided to 8.1 to 8.9 billion of revenue, so the midpoint about 8.5, consensus at 8.8, so potentially a miss on the cards there. And the reason behind that is weak outlook in China and weak outlook for the smartphone market, and those two things kind of intersect, but together China and smartphones both about 60% of their revenue. Now they are shifting and diversifying into areas like automotive chips and Internet of Things chips, and they even talked about AI on their call too, but those things are not yet big enough to really compensate for those sluggish trends they're seeing in China on smartphones. So yeah, kind of a disappointing print essentially for Qualcomm there.
Well, Matt, speaking of those smartphones, let's talk about Apple and even Amazon reporting after the bell. Is it still all about the iPhone?
Yeah, I think it is obviously that the iPhone 15 is due out in the kind of final months of this year. So I think there's some optimism around what they'll say about volume there. But I guess maybe on the back of that Qualcomm print, perhaps people's optimism will be kind of pared back a little bit. And on Amazon, obviously, most of their revenue comes from online retail. But what's in focus there is the cloud business, which generates most of the profit. And some questions there about their AI strategy for that business. So I think that's where the focus will really be, and whether we see a significant slowdown in growth. People are looking for about 10% year-on-year growth at the cloud business from 15% last quarter.
Okay, Matt, thank you very much. A lot to cover. The two heavy hitters from the U.S. market. Matt Bloxson from our Bloomberg Intelligence team. Now, coming up, we're going to get back to the European earnings story. We had SocGen beating estimates in its first report under the new CEO. That's next. This is Bloomberg.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We had a very, very strong third quarter, and now based on the mega trends we are very much benefiting from, be it electrification, be it renewables, be it IoT or data center, we could continue to believe also in a strong finishing quarter, another 4 billion. So therefore, we are reconfirming all our formally communicated targets for the year.
That was the Infineon Technology CFO speaking to me and Mark Cudmore earlier in programming. Now, he might be confident there, but shares of Infineon are falling the most in 2 years. The company's fourth quarter outlook raised concerns about profitability for the chip maker. Joining us now is Bloomberg's Germany correspondent Oliver Crook. Oliver, talk us through these results. What's got the market so concerned?
Yeah, he may be positive. The market certainly taking a very different view of that this morning. We're at sort of session highs at -8%, and really it's a question of profitability. It's a question of margins. They came in a little softer this quarter, and really they're looking even softer going forward. And on top of that, they're spending big to open a new fab over in Malaysia. That's 5 billion euros. Investors perhaps a little concerned that that might be overstretching a little bit. So we had the biggest drop since the pandemic today. But remember, if you held this stock from the lows of the pandemic, you've more than tripled your money. This is, overall, so let's not lose sight of that fact. We've got the CEO now on the earnings call saying that he's very bullish on China and China autos, which is probably reflecting why they're opening that fab there in Malaysia.
Let's get to another German company reporting today as well. Solid set of results coming from Adidas. Walk us through those numbers.
Yeah, they've been bouncing around. They opened a bit higher, then lower, and up again. And really, it comes down to volatility and inventory. Inventory is still a massive problem over at Adidas. They've got 5.5 billion euros worth of that. Came in a little bit higher than what they had been anticipating. And really, when you look at the sales, it's a little bit concerning. The good part is China. Sales were up 16% in the second quarter. The bad news, North America down 16%, and EMEA basically dead flat. And EMEA and the United States and North America are the biggest markets. Now, I know what you really want to hear about, which is Yeezy. They managed to move 400 million euros worth of Yeezy inventory in the second quarter. This was seen as sort of a stranded asset potentially for a lot of investors, so they've managed to sell some of that. And we're learning now from the earnings call how much of it they're going to give to charity. From the second quarter sales, 110 million euros of that is going to go to charities.
Okay. And just seeing some lines out from Adidas too, the CEO speaking in a media call saying that they won't try to sell Yeezy products under a different name, and Yeezy likely to include cheaper products.
And the reason for that is they can't get the wheat. It's interwoven into the sneaker, so they can't actually get it out. They tried, they looked at it, they couldn't do it.
I'm trying to think, you could like change the Y into something else. I don't know. I'll have to think about that one. It'd be too expensive anyway. Oliver, thank you so much. Bloomberg's Oliver Crook in Berlin. So that's the German corporate story. Let's talk about the French corporate story, because SocGen beat estimates, most estimates I should say, even though key revenue lines weakened in a lackluster trading environment. Let's get over to Bloomberg's Caroline Conan on this. Caroline, it's the first results under a new CEO. What did they deliver?
Actually, SocGen positively surprised this morning because analysts were expecting a very lackluster quarter, and it was not as bad as expected. So, for example, if you look at equities trading, revenue fell 6% compared to like 3% for the French rival BNP Paribas that reported last week, for example. But that was a beat compared to estimates. Also in fixed income, revenues fell there 18%. That's in line with BNP Paribas, but also better than estimates. So overall, revenues was down in most divisions, but above estimates, so not as bad as expected. The new CEO, Krupa, actually said in the analyst call just now that inflation, he thinks inflation is not yet under control, but in theory, the changes in monetary policy should support trading going forward. One of the units that was actually a drag also was the French retail, because in France, banks have a hard time to pass on the increase in interest rates because a lot of the time mortgages have rates that are fixed and the new loans are capped. So also very difficult when it comes to French retail.
Caroline, thank you very much for that. SocGen shares up 2.4%. Coming up, we'll talk about the BOE with Liz Martins, HSBC senior economist. All of that next. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power and the
balance of power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case that
it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Treasuries extended a sell-off as Bill Ackman says he's making sizable bets on declines for 30-year U.S. Treasuries. Meanwhile, the BOJ steps in with an unscheduled bond buying for a second time this week. Across the country, the world, if you will, the Bank of England decides the BOE is expected to boost rates again today, with the market and economists split on whether it's a quarter or half-point hike. Plus, of course, tech earnings continue. Heavyweights Apple and Amazon take center stage later today. But first, we'll assess a slew of earnings coming out of Europe, including SocGen and Adidas. I'm Kriti Gupta in New York with Danny Berger in London. Danny, so many cross currents here, but it really does feel like a day 2 of really what we saw yesterday, that downgrade spurring a lot of repositioning.
It did. Also, the Treasury, with the amount that they're going to have to borrow, the issuance that will come from that. We heard Bill Ackman saying, of course, short the 30-year yield. It's the most obvious trade in markets right now. If supply is going to increase and if inflation stays more stubborn than expected, it does mean that globally, bonds just aren't behaving as any sort of ballast in the storm. It's stocks and bonds selling off. FX markets a little bit volatile too. Here's what we're seeing in European stocks. There are a lot of earnings. We had some big disappointments. We had a big disappointment from Infineon, a big disappointment from LSE. Some of those large cap moves are really what's weighing on us. Again, plus that just overall macro story of gloom. Stock 600, it's off of its lows, but still down 0.9%. FTSE 100, that's underperforming even more. You get a lot of global facing companies here. So if it's a global sell-off, it makes sense that the FTSE 100 might be leading some of those declines, down 1.33%. We're also going to get a BOE decision, Kriti. You just mentioned this. And the sell-off we're seeing in bonds right now in the UK and gilts isn't about that. It's about this global sell-off we're seeing, and that is evidenced by the fact it's duration that's selling off, much like the U.S. 30-year yields, Kriti, higher by 5.5 basis points.
Yeah, well, the sentiment you're seeing in Europe is really just flooding right here into the States, both on the stock front and the bond front. We'll start with the equity story. S&P futures down about 0.3%. What I will say is they are paring some of their losses. In just the last 30 minutes, we've been on television. You've already seen a little bit of a reversal when it comes to futures trading. 45.23 on those contracts, you should really see that's pulling back pretty crucially from that 4,600 level. A lot of the pain, though, is isolated or concentrated. I'm going to get my words right. Concentrated today, I should say, in a lot of the winners we've seen, which really brings us to big tech. NASDAQ 100 futures down about 0.4%. So again, seeing a little bit of a day 2 pullback. Danny, if this is the start of that mini correction Jay Woods told us on our show earlier this week, then this kind of is starting to look a little familiar with what we see seasonally in terms of the equity market. The bond market, a similar story. And again, I would say at the whim of the BOE today, 4.14 on the 10-year yield, higher by 7 basis points already. But look, you go to the front end of the curve, you're not seeing that same move. So really keep an eye on what this 10-year yield does as soon as we hear from the Bank of England. I want to dirt out a bit, Danny, and really talk again about central banks around the world, because in the absence of a really clear trade in terms of whether or not we're going to hit a soft landing or a hard landing, there is a carry trade that has been afloat. The Mexican peso, the super peso, if you will, against the Japanese yen, and the continued weakness you've seen there. Well, today that trade is flipped on its head, down about 1.6% in favor of the Japanese yen. Danny, this is really important because, of course, we know the BOJ has tried again to step into the bond market for a second time. How long will that strength last in the yen?
And here's the risk, Kriti, is that amid all of that volatility, we could get something unexpected from the BOE that will just increase it. Let's focus in on that, because expectations at the moment for the Bank of England is that they'll hike rates again. But the thing we're not so sure about is whether it will be 25 or 50 basis points. It's a subject that both markets and economists are divided on right now. Let's bring in Liz Martin, senior economist at HSBC. Liz, I want to get your take. What is your expectation, 25 or 50?
So our forecast is for the 50 basis points, same as last time. And that's because, yes, the winds around the world are blowing in a more dovish direction. But, you know, the UK, the Bank of England, is facing a particularly acute inflation problem. You know, core inflation 6.9%, private sector pay growth nearly 8%. So the forecast that we put in place last month was for 50 basis points. Now, as we've, you know, moved away from the decision last month, the data have come in more dovish. So we had a downside surprise in inflation, we had some soft PMIs, and I think the risks to that 50 have certainly increased. But, you know, talking to clients and investors through the last couple of weeks, no one's got very strong conviction on this. Could it be 25? Of course. Could it be 50? Yes. You know, the Bank of England has surprised us in the past, so we'll find out in a couple of hours.
Yeah, I mean, let's hope it's 25 or 50, because I feel like it's just going to be absolute mayhem, if not one of those, Liz. On 50, if I can just play devil's advocate, I mean, why rush? Why go at it jumbo? Is there really that big of a difference between going at it 25 or 50 again when the latest prints have showed some relief?
Yeah, well, I think that people will be making that argument. There's another argument which says, you know, if you're going to do 50 anyway, why not do it quickly? And then you can stop sooner, especially if we think other central banks around the world are done with their journeys. Does the Bank of England want to be the one that's still raising rates towards the end of the year and into next year? But regarding that downside surprise on inflation, we certainly hope that it is the start of a continuing trend where UK inflation falls back. But we had a downside surprise in UK inflation in January. It was then followed by 4 massive upside surprises, which led to the BOE having to be more hawkish. So I think good news that we did have that lower number in June, but we're not counting our chickens that that's inflation done and dusted now for the UK.
Well, Liz, talk to us about the role that quantitative tightening plays here. The BOE was one of the early movers on that front. How is that going? How effective is it? Walk us through that side of the story.
Yeah, so we're coming up to the first anniversary of active sales. The Bank of England said, you know, they were going to do £80 billion a year. They've done that. And actually, I don't think it's made a tremendous amount of difference to anything. Of course, the BOE was we were the global guinea pig for this. Other central banks have done passive quantitative tightening, so not reinvesting the proceeds of bonds once they mature. But the BOE was the first to come out and say, well, we're going to actually sell into the market. And lots of people were worried about that, particularly, I think, in conjunction with high levels of supply of new debt from the UK government. But actually, I'm not sure we can point to a huge additional impact, either in negative terms, in terms of raising the cost of borrowing, or in terms of actually making a difference to reducing inflation. But we have come up to the year point, and the Bank of England will need to update us on what they're planning to do. We're expecting them to comment not today, but actually next month in September. And actually, they're talking about raising the pace of quantitative tightening. And that probably tells you quite a lot. If they're able to raise it without worrying that that's going to slow down the economy too much, then that tells you that it's had a relatively small impact overall.
And listen, factor in the currency story for us as well, because I'm still waiting for some material currency weakness, given that the BOE really hasn't been able to crack down on inflation to the extent that some of its peers has. I'm looking at 126 on the cable rate. How does that factor into all of this?
I think, you know, if we just think about the August meeting relative to the last one, actually sterling is up on a trade-weighted basis since then, and that will reduce inflation a little bit. But of course, that's not the BOE's kind of main priority. You know, they're more worried about the kind of underlying supply-demand factors in place. So I don't think the currency is probably going to be a big part of the picture today, except that it contributes to a slightly lower inflation outlook from here, and we do expect them to be revising down their inflation forecast, not just because of the currency, but partly because of that.
Liz, I need more weakness in the pound, so when Kriti comes to visit me here in London, breakfast will be on her. So away from selfish matters, when it comes to the composition of the MPC, we do have a difference this time. We have Megan Green now replacing the most dovish of members, Silvana Tenreiro. Megan Green, definitely more hawkish. How does that change the composition and the split of decisions that we're likely to see today?
Well, look, the reality is there's been two uber doves on the MPC, Silvana Tenreiro and Swati Dhingra. They've been voting for no change in interest rates for quite some months. I think if they had their way, bank rate would still be at 3%. And the reality is that, they make for an interesting debate, but they haven't been leading policy. So the loss of Tenreiro and replacement with Megan Green probably doesn't make a huge difference to the direction, but it makes the committee slightly more hawkish on balance. But generally speaking, what's driving the majority decision? It's not what Silvana Tenreiro or Megan Green thinks, it's what the governor and the kind of core internal members think. But we don't know too much about how Megan Green thinks about the UK economy. We've heard a few bits and pieces from her. My best guess today is that she'll vote with the pack, and we will get probably an 8-1 vote, with the 8 going for a hike, whether it's 25 or 50, and the 1, Swati Dhingra, sticking with her vote for no change. But, we will see.
Okay, so perhaps the composition not really changing things too much. What about the politics, Liz? Of course, the Bank of England is independent, but we've seen in the past how politics affects their decisions. If we are heading into what's likely an election year for the UK, if we have, for example, Jeremy Hunt's economic advisors concerned that they're going to tighten too much and do damage to the economy, what difference does that mean for the BOE moving forward?
Well, I can see why one might make the argument that the government won't want rates to go too high, because that's, making us all have to pay more on our mortgages and slowing the economy down, and nobody likes any of that. On the other hand, nobody enjoys persistent spiraling inflation, and I actually think the government, what the government said in the past indicates that it is very focused on that. Jeremy Hunt kind of said to Andrew Bailey, you need to do what it takes to get inflation back down, because, a recession is one thing, it's not nice. High mortgage rates are not pretty either, but, the government is a big victim of high inflation as well. A quarter of our national debt is linked to inflation. The public finances are under pressure because of inflation. So I think the government wants the BOE to do what it thinks is necessary to get inflation back down, and then hopefully rates can come down at some point after that. But it's an ugly economic picture going into the election, I think, kind of either way, really.
Liz, what I love about having you on our show is that you can talk about any central bank around the world. So let's broaden this out a little bit. When you talk about the BOE and the stickiness you were seeing in the UK specifically, is there a read-through towards the Federal Reserve, towards the ECB? Is Christine Lagarde or Chair Powell really watching that closely? What's happening with Andrew Bailey's England?
I think all of the central banks are all watching each other, right? And we're all grappling with broadly the same problems. However, I think, particularly Chair Powell will look at the UK and think we've got a considerably worse problem in terms of core inflation, a couple of percentage points higher in the UK and no decisive downturn. So I think the UK and the US economies are in different positions, and I think we'd be more optimistic about inflation coming down a bit more quickly in the US perhaps than in the UK. But for the Eurozone, I think it's very similar. And actually, you could make the argument that the Eurozone is at an earlier stage in its journey, just starting to see wages pick up, whereas the UK, hopefully, we're kind of more at a turning point. So very similar issues, I think, for the UK and the Eurozone. I think the debate's going to be the same. When we heard from the ECB last week, the question was, well, are they going to go in September now or not? And the same question, I think, possibly will apply to the BOE this afternoon, depending on what we hear from the committee. So, similar problems, but I guess varying degrees.
Is the ECB, though, in terms of what's different for them, in terms of their uniqueness, they're more early on in the stage of the rate hiking cycle, but given the economic data, is their headroom less than the Fed with stronger American data, maybe even less than the BOE? Does the ECB, again, just have a smaller runway on where they can take rate hikes, even if inflation would seem to dictate that they should go further?
Yeah, well, look, we're only forecasting one further interest rate rise from the ECB in September, and they indicated that it might not even be that. Potentially they could have stopped. What we saw last week could be the last one. But as you say, they've got some growth problems. I think, a lot of, say, Germany's problems relate to the manufacturing sector, which is really not where the inflationary problems lie. Globally, if we look where we've got inflationary pressures, it's much more on the service side. And, I think from the PMIs today, you see that service sector demand is holding up more strongly. So they do have a bit more strength in that sector. But I agree with you. You know, slowing economy, it will be hard for them. And as I say, only one more hike on our forecasts.
HSBC's Liz Martin's walking us through the central bank stories around the world. We thank you, as always, for joining us. And, of course, we're going to come back to the story that seems to be moving the markets for 2 days now, that Fitch downgrade from, of course, AAA to AA+. That moving the markets yesterday. Day 2 is today. We're going to dive into exactly what the reasoning was. Stick with us. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Fitch Ratings' decision to strip the U.S. of its AAA credit ranking highlights the booming deficits at the heart of the bear case for treasuries. Bloomberg spoke to Richard Francis, the company's co-head of America's sovereign ratings, about its reasoning behind the decision.
We did, right after the resolution of the debt ceiling with the Fiscal Responsibility Act, mind you, just 2 or 3 days ahead of the X date when they could possibly not make some kind of payments on its obligations. We indicated then that we would resolve the rating watch in the 3rd quarter, and we wanted to take our time. We wanted to opine upon the impact of the Fiscal Responsibility Act itself on the deficits and on the debt level. We wanted to update our own numbers and look at where we think the fiscal trajectory and the debt is going, and we wanted to just take stock of the actual debt ceiling debate and its resolution as well. So we wanted to take our time and give a thoughtful analysis to both the fiscal picture and on the kind of governance issues and as well.
It's worth talking a little bit about the criteria you set out about a year ago, about what it would take to get to a downgrade, because some of the things have changed in terms of the picture. Let's start with the rise in debt to GDP ratio. The significant and sustained rise did not be so significant or sustained. So why is that not factored in here in terms of the decision made more recently?
Well, the debt level has been rising quite significantly. If you look at before the great financial crisis in 2007, debt to GDP was at below 60%. Now it's 113%. The 113% is almost 3 times higher than the AAA median, and it's more than twice as high as the AA median. So you've had a sustained, deterioration over the years. Yes, debt to GDP peaked during the pandemic at 120% and has come down, and that's because of inflation and high nominal GDP growth, and also the withdrawal of the stimulus, especially last year. But now we're seeing debt levels starting to rise again, and we do not see them stabilizing. We just see them continuing to rise in the next 3 years, and probably more over the medium term. And that 113% is still 13 percentage points higher than where it was before the pandemic. So you've had quite a deterioration on the fiscal and debt side.
Richard Francis there of Fitch Ratings talking to us about that downgrade, which, Danny, has spurred a sell-off both in the stock and the bond market over these last 48 hours. I think it's really important to keep in mind, though, that even though there has been a lot of pushback on exactly what Fitch is saying, they also have a point, which might be something that the bond market is pricing in.
Yeah, I would also say, Critty, that this goes beyond what Fitch has done. I mean, it's summer market. There's more jitters. And at the same time, the Treasury has been talking about the issuance that they need to do, the supply that's likely to hit markets. All of that feeding into why we're seeing a sell-off in duration. Ackman laid it out for why he wants to short the 30-year yield and says about an uptick in inflation. We might not even need an uptick in inflation for more things to sell off, Critty. Perhaps just more inflation volatility.
Yeah, a lot of cross currents here from both the fiscal and the monetary side. We're going to, of course, keep you posted throughout Bloomberg Television and radio. Coming up on the show, a look at some of the market-moving events to watch throughout the day, including earnings from Apple and Amazon. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
I'm actually feeling very positive, I'll say bullish about the environment in this market. There are a lot of changes moving in the right direction. You hear some comments questioning some of them, but I think overall the momentum is very much moving in the right direction.
That was the London Stock Exchange Group CEO David Schwimmer speaking to us earlier. He thinks things are going to come back at some point, but at the moment, it was their first half results that sent shares lower, down by 1.6%. The concern was a small EBITDA miss, but a miss nonetheless. So that first half growth faltering, that's what's moving things here. AB InBev, one of the bright stories to come out today, the beer maker, really strong results, especially in LATAM. It's clear they've gotten away from some of the Budweiser controversy that's been plaguing them. It also just shows that Heineken results, in retrospect, were pretty weak considering that AB InBev was able to turn it around. BMW also gave a lower cash flow guidance. They had pre-warned earlier in the week. We got the details today. The market's still not happy about that, down 2%. In Lufthansa, again, it's a story about costs and also their debt load. So those shares pretty falling some 5%.
Yeah, and I would argue a similar story when it comes to the States, because we did get a ton of earnings here stateside, Danny, overnight, which aren't necessarily being well received by the market. I want to walk you through PayPal to kick it off with. They're talking a lot about transaction margins really missing. And get this, Danny, analysts not happy about it. Shares down about 8.4% here, prompting, get this, 8 price target cuts across Wall Street. So seeing a lot of pain in that stock. Again, it all comes down to margins, which is a similar story for Qualcomm as well. Of course, the chip maker that is well known for being an Apple supply chain, setting off a wave of red across all the chip makers, basically falling on handset weakness, some of the slump that's already baked into the market, and of course getting downgrades again from Wall Street. Qualcomm shares also down about 8.7%. But Danny, all the focus, and I think what could really change the tune of the entire market, what we hear from Apple and Amazon after the bell. Apple shares down about 0.3%, but a little bit more optimism when it comes to Amazon, higher by 0.5%.
Yeah, again, this market doesn't like tech at the moment, be that for some of the earnings, be it for the higher yields. As you say, could Amazon turn that around? Apple really has been the darling of this market. There is certainly amount of earnings volatility priced in. Just looking at it, the one-day implied move on options is about 3.5% for Apple. It's not too big considering we have seen bigger moves. But yeah, Kriti, again, this could definitely shape the direction of tech for the next quarter.
And of course, we know that a lot of people have been waiting for that mini correction, some sort of 5% pullback. Of course, that all would start, in theory, from big tech. That does it for early edition. Surveillance is ahead. John and Lisa are going to take you through an all-star lineup. This is Bloomberg.
Faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
When rates are rising and cyclicality is still outperforming, I think it's a message that the market's comfortable.
Are people really going to be willing to accept a 4% 10-year note? It seems so high to us because it's been so low.
Those terrible fiscal trends are going to remain in place.
No central bank is stopping governments from issuing debt.
The options market in general is absolutely terrible at pricing political and geopolitical events.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Following the biggest one-day drop on the S&P 500 since April, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. It's all about the bond market jitters out there following a US downgrade, some half-decent jobs data, and the Treasury announcing a ton of supply. Let the market speak for itself. Drain the drama. Yields up every single day of this week, but minor moves. Let's get the board up if we can in the bond market. 10-year UK, 10-year Japan, 10-year Germany. Let's look at a 10-year Treasury as well. Bramo, looking at the yields right now, higher by 6 basis points, 413.64 on a 10-year. Highs of the year, but I wouldn't call it dramatic.
It's not dramatic, but the slow bleed upward has gotten new focus as we reach some levels that we haven't reached going back to last November. And suddenly this is the main story again. You could talk about Fitch and the downgrade yesterday, but a lot of people view that as simply an excuse to really catalyze the fears of the fiscal overhang, of the new borrowing schematic from the U.S. Treasury Department, which is bigger than people expected, and this general concern that if the economy is going to recover, okay, maybe you get a soft landing, maybe you get a no landing, maybe you also get stickier inflation.
What did you make of the equity market move? An excuse to sell or a reason to sell?
Excuse to sell. That's my gut. It was an excuse to sell for people who weren't necessarily buying the rally because they believed in it, but because it was FOMO. And we heard increasing numbers of people saying you got to go with momentum. Suddenly, the momentum seemed to shift just a touch, and so it was an excuse for people to sell who couldn't really justify it from a fundamental perspective.
We've got a great guest this morning, so let's not waste any time. Your equity market on the S&P 500, slightly negative by 0.2%. It's a little bit softer. The move in the bond market on a 10-year Treasury getting everyone's attention this week. This morning, higher by, let's call it 6 basis points on a 10-year to 413.64. Lisa, the data was decent. The ADP report just yesterday. We've got a US downgrade. The Treasury supply seemed to be the story the day before and yesterday as well. I think that's what we have to spend a little bit more time on this morning.
I would completely agree, and it really feeds into a broader concern of at what point the debt that people have incurred during the pandemic before that becomes unsustainable with higher rates. The Bank of England will have to address that to some degree today. They have their rate announcement at 7:30 a.m. press conference, but Bank of England Governor Andrew Bailey, their inflation picture, yes, it has been coming down, but is still the highest among the G7 nations. And it comes at a time where we hear Rishi Sunak telling his population, just trust me, I can bring it down. Then today, just on the economic data front, we got jobless claims at 8:30, factory orders, durable goods, and ISM services index at 10 a.m. I am actually most interested in ISM services. Want to see if you see ongoing strength there, if you start to see a little bit of a cracking in the area that was supposed to provide some momentum. And we do get Richmond Fed President Tom Barkin speaking at 8:30 as well, just to counter program. And of course, Apple and Amazon. Remember, we were supposed to care about them most of all.
We still do.
We still do.
After the close.
This was supposed to be the dominant story in my mind for Thursday, right? To me, I thought the earnings picture would definitely cloud everything else. They've gained about 50%, both of them, so far this year. How much further can they run? With the yield backdrop, is yields, the yield space, the primary story, even amid a tech rally that's been unrivaled, according to some metrics, ever?
Let's see how they set the tone going into Friday morning. Payrolls tomorrow morning. The estimate at the moment is still about 200K. There's a fantastic line from Julian Emmanuel of Evercore. I want to share it with you. This quote here. Throwing in the towel, upgrading one's view in the month of August has been bad for one's P&L. They top in August, September is a sell, October the panic sets in, and then you buy. Year after year after year after year. Who really wants to come back from the beach? Julian does. He's with us now. Julian Emmanuel. Julian, good morning to you. What is it about August?
The beach was boring. It really is if you look at it, the complacency sets in, people do actually go away, and frankly, there are problems that tend to get papered over and wait until September. It just so happens that we're in one of these environments where if you look back over the last year, when yields have moved to where we are now, you've had equity market turbulence, whether it was September with the UK turbulence or March when the yields peaked above 5% in the 2-year prior to the bank crisis. And here we are again. And should we really be surprised given the downgrade, given the excess supply, and given the fact that Japan is now actually going to compete for funds in a global asset allocation framework?
You've gone through a few points there. There's so many things going on in this bond market, and it's hard to strip out what's driving it and what isn't. The downgrade, the data, the Treasury supply, the fact that BOJ has tweaked yield curve control. Does it matter why we're here, or is it just the fact we're here on Treasury yields right now? Do the reasons behind the move matter at all?
Well, look, there's always the longer-term picture is given the supply that's been announced, that is a reason, and obviously to us, that is a reason that the rate of descent, should we get the economic slowdown that Ed Hyman is forecasting, is likely to be lower than expected. But the fact is, when you think about it from an equity market perspective, from the bank crisis trough till a week ago, the NASDAQ was annualizing at 100%. It's just not a surprise that we're pulling back here.
Taking a step back, what you just said is that at this point, yields are making stocks squeezy, right? I mean, that's essentially where we're at. And this has been one of the big questions. Why have stocks been so resilient as yields slowly climbed upward? This hasn't been a massive sudden move, as John was mentioning. So have we gotten to that tipping point where suddenly yields shift the narrative at a time when people still are talking about economic resilience and cause stocks to really look queasy, even if the economic data comes in well?
So from our point of view, this is a correction as opposed to an end of the run. And that's really because when you step back, even though we are looking for a recession sometime over the next 12 months, the data doesn't support that in the here and now. And if you look at the history of the stock market, it's very often the case that things keep going and going and grinding higher until you're hard upon the recession. And I would also point out, when you think about it from a supply and demand point of view, the public, who is a large holder of these stocks that have done so well, of these stocks that are reporting after the close today, doesn't have to feel forced to sell their shares as long as they have a job, and the jobs market is very strong, as we know.
So are you saying that we could see, a little bit of a dip, but nothing that significant, nothing that really portends a shift in allocations or something that's a little bit more sustained?
Not until the economic data start breaking weaker. To us, this is going to be, again, the seasonal garden variety, a little bit too much ebullience, a little bit too much of the hardcore bears throwing in their towel. Just wait for the pullback and
You're not naming
be a
any
buyer
names,
of dips.
right? No names naming today?
Look, we raised our price target in June.
Okay.
So,
When you say correction, 5%, 10%, what are you looking for here?
So if you think
it's one day of losses, one day of decent-sized losses on the S&P, and we're now talking correction. So what are we talking here?
So if you think about it, again, the history of this year, essentially the NASDAQ, as we all know, started ripping at the trough in March. And then in June, when you got to 4,200 in the S&P 500, that's when the participation started to broaden. That's when we turned more optimistic and moved our price target up to 4,450. It wouldn't be a surprise. It shouldn't be a surprise if we retest that 4,200 level at some point.
By the weakness is the message that you're sending this morning. By the weakness where? What kind of pockets of the market you're looking to pull back and want to buy?
So this is sort of a barbell strategy, okay? We are long-term believers in the power of AI to transform industrial society. You need to own those names. The problem is that when you have a correction like what we think we're entering, those are the most volatile names. That's where you could draw down 20 or 30%, which is why, A, we like option hedges, but we also think that the names that have been overlooked, the winners from last year, healthcare, energy, those are the names that we think and the places that we think, again, you want to go where people are not, and people are not there.
With this backdrop, where does the Apple-Amazon earnings picture fit in? In other words, how important is that in deciding where to start looking or how to start hedging as you head into a potentially more volatile period?
So to say that those two stocks aren't going to be important is just thoroughly naive. They are going to be very important, but it is much more a function of how, and we've seen this entire reporting season. You know, you can have a good report and your stock price behaves poorly. You can have a lackluster report and your stock price behaves well. It is all about the share price reaction. And to us, again, if we look at the last couple of weeks, there's probably a little bit too much exuberance in those names. So it wouldn't be a surprise that you see a modest pullback, but nothing cataclysmic.
John asked me earlier, is this an excuse to sell? And are people using yields as an excuse to sell? Is that kind of how you look at the earnings of these giants that have returned 50% so far this year, give or take? And we're looking at this hope of artificial intelligence that can't yet come through in the earnings. It just isn't possible. Are you saying that there could be that kind of reaction and that then you'd be looking to buy?
That's basically the story. And when you think about the spend and the transition to a productivity bump from AI over the medium and the long term, those budgets aren't likely to really go into gear until mid-24 and 25. The intent is there, but again, for the stocks, you have to bridge the long-term thesis with the short-term volatility.
Have you seen Tom Brady's getting into English football? Did you see that story this morning?
My goodness gracious.
What do you make of that, Lisa? We're going to catch up with Todd Wagner, by the way, the hedge fund manager, a little bit later this hour, who's made his push into championship football. So second tier of English football in the UK, Lisa.
I have actually a lot of thoughts. First of all,
why Birmingham City?
Well, why Birmingham City, although this is a distressed debt investor, and then this is Tom Brady. And I'm wondering whether they're going to come out with a documentary or a movie, because that seems to be, you know, the Netflix series of Birmingham. I mean, honestly, this is going to be very much in the public eye, because that seems to be the playbook. But also, you know, whether he has thoughts about the eating, the dietary restrictions and things like that. He's going to weigh in on all that. And
I could recommend some restaurants in that area.
I don't think that that's what he's talking about. That's just my sense.
We've got to teach them how to say Birmingham and not Birmingham.
Them, do you mean me?
Birmingham.
I think that you mean me.
Let's see how Tom Wagner deals with that a little bit later. He should know it's Birmingham.
You'll scold him otherwise.
Birmingham.
Duly warned.
We'll see how much he knows about this city. We'll do a little test.
Oh, my goodness.
In about, I grew up 30 minutes away from St Andrews Stadium, so... You know, we'll do a little test 30 minutes later. Julian, it's good to see you, mate. Julian Emmanuel of Evercore. I think it's really cool. Much more interest in football, going into the lower divisions. Fantastic support for some of these clubs. It's really tough to make it in a championship. Really, really tough to try and get that promotion from there to the Premier League. I wonder why out of all the leagues in English football, they picked that one. And I wonder why all the teams out of that league, they picked that one. I'd like to know the thinking behind that. I'd also like to know the makeup of the investment. Is Tom Brady just along the ride because of the branding, or has he actually put significant cash up to invest into this venture?
All great questions. There is a playbook starting to emerge, and we saw this most obviously with NASCAR, or Formula One, excuse me. I'm going to get pilloried in the break for making that assessment in any way, shape, or form. However, there's going to be also this playbook that you start to see roll out, where you take a team that's kind of been relegated for a while, that isn't very popular, and you suddenly make it a movie star or some sort of TV star, and then it gets popular, and you get ticket sales, and you get endorsements, and suddenly you can afford all of these things that you couldn't previously afford. And I wonder how much that's part of the playbook.
So the way I think about it in terms of stocks, is it easier to do that with a small cap than it is a mid-cap stock?
Yes.
right?
Yes.
So I understand why Ryan Reynolds went for something like Wrexham.
Exactly.
Right, which is like a micro-cap stock in terms of the equity market of English football. And then something like, I find it curious. I want to know.
I know, but
want to know.
this is exactly what.
Why something of that size in that league?
But don't you think that could be the playbook? You take it, you make like a made for Disney movie.
It seems to be.
Yeah.
I think it's better if you're the first in, and Ryan Reynolds was, and I wonder how difficult it would be to follow. We'll have that conversation later. In about 45 minutes, a Bank of England rate decision as well from New York City. Good morning.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, Friday on Bloomberg Television and Radio.
I strongly disagree with Fitch's decision, and I believe it is entirely unwarranted. Its flawed assessment is based on outdated data and fails to reflect improvements across a range of indicators, including those related to governance that we've seen over the past 2.5 years.
I think we'd love to know about the improvements on governance down in Washington, D.C. That was Janet Yellen, the U.S. Treasury Secretary. Many investors weighing in on the ripple effects of the Fitch downgrade. Rubberbank's Jane Foley had this to say. It is possible that over the medium term, the U.S. dollar will be impacted more by the political reactions that the Fitch announcement generates, rather than from the announcement per se. Jane joins us now for a little bit more, head of FX strategy over at Rubberbank. Jane, just walk us through that, the significance of what we heard yesterday to this FX market.
Well, I mean, the significance in some respects, from an academic sense, is fairly huge. You know, we're looking at a budget deficit that has been rising as a percentage of GDP, despite the fact that, you know, the growth outlook has improved relative to market expectations in recent months. And we're also looking at, you know, a debt that's really quite high as a percentage of GDP, particularly when you compare that to pre-pandemic levels. Now, the US is certainly not alone in that respect. You know, there was a lot of pandemic spending. Fiscal policy was pretty expansionary, and on top of expansionary monetary policy, and that's one of the reasons, of course, we have, you know, high inflation. But of course, the US Treasury market isn't like other bond markets. It is the benchmark when it comes to safe haven. And so you don't get that same sort of reaction to bad news that you would have elsewhere. You don't get, people selling off bonds, but, it has brought the conversation back. It has brought attention back to the fiscal situation. A lot more people looking at next week's supply, for instance, in the Treasury market than they would have done otherwise. But, it is a problem because there's such a bipartisan political system. You can't have this sort of data from Fitch, etc., imparting the sort of discipline on policymakers that you would expect to see in other countries. And that's potentially a bit of an issue.
Jane, you mentioned the Treasury supply. Did you sense that was the more important factor behind the move in yields that we've seen over the last couple of days?
I think it's part of the reason. I think it's very difficult to dismantle, but certainly it is there. A lot of people looking at the increase in supply, across various different tenures of bonds and thinking, there's a lot of weight to come. Would that have been more of a focus if, that there hadn't been this announcement from Fitch? Well, maybe not. I'm an FX person, and yet, I've been looking a lot more at the refunding next week than I would have expected me to be normally doing. So I think that the Fitch announcement has drawn lots of people's attention back onto fiscal policy, back onto the fact that the budget deficit in the US is too high, and onto the fact that partisan politics mean that nothing much is going to be done about that. So, it is a concern, and I think it does mean that the supply will be watched a lot more carefully just to see how the market absorbs it next week.
You said you're an FX person, and I have to say this incredible irony that we're dealing with the potential for a further downgrade of the U.S. or some sort of fiscal irresponsibility leading to a protest among investors, leading to dollar strength, and the likelihood that that's going to continue, at least in the near term. How disruptive is that? How much do you pile on this dollar strength kind of train after a lot of people had abandoned it for months?
Well, again, I think there's various different aspects to this outlook for the dollar as well, and that the safe haven bid may be related to the US fiscal situation, may be one aspect, but I think it's more to do with the resilience of the US economy. Look at the ADP number that we've had, look at a variety of economic data coming through saying, where is that slowdown that we were expecting? That the whole part of the first year in the US can be, determined by just the word resilience. We saw so much economic resilience. Look at the stock markets, etc. So I think now the market is thinking, okay, maybe we cannot completely discount the risk of another Fed interest rate hike. We certainly can't discount the risk of higher for longer interest rates. And at the other side of the coin, you've had Brazil, for instance, cutting interest rates already by 50 basis points. Some of those interest rate cycles in emerging markets are far more mature than in the US. And you've got this position, certainly in the ECB, or with respect to the ECB, where actually rates may have peaked there too. They may be coming towards the end, even in the Bank of England. We can see the beginning of the end there. So, the dollar story, I think, takes on a different context when you look at the other side of the trade and you see potential weakness elsewhere.
How much room do you see to run at a time when you do have the potential for a pause at the ECB, where people are expecting the Bank of England to hike by 25 basis points today? That's the general call at this point, and then maybe even stay there for the time being.
Well, we've got to remember that the market has gone into this ECB and the Bank of England meetings really quite long, of both the euro last week and sterling this week. So those positions may have come off their recent peaks, but they're still pretty long, and that's really important, because if you're going into a meeting long, then obviously there's more scope for disappointment. Now, we've seen sterling today underperform a bit. It's about the weakest G10 currency today. Maybe the market is just taking some of those profits, and that doesn't surprise me. A few weeks ago, people were fairly certain that there would be a 50 basis points hike. Now the market is seeing more chance of a 25 basis points hike. I would be in that camp, and that's because there are signs of weakness in the economy coming through, and the Bank of England should be picking that up in their agents. We're certainly hearing from our corporate customers in the food and agri sector, that their customers are making different decisions now, probably because of the impact of inflation and the impact of interest rates on their budget. So I think the Bank of England should be picking that up, and I think there's just going to be a 25 basis points move, and some of those long positions are reacting to that.
Never mind Bailey. Governor Ueda has had quite a week, hasn't he? Jane, what is the Bank of Japan up to?
Oh, well, that's what we're trying to figure out. You know, it is quite interesting that they've come in twice, you know, since last Thursday, today, and again, in unscheduled bond purchases. And this is really important because this is really allowing the market to draw more information about, well, what exactly did they mean last week? So we saw a tweak in policy. You know, to what extent was that, you know, just a technical move to help with the better functioning of markets? Or how far are they going to allow bond yields to push up? So we're getting more information. They certainly don't want a quick run to 1%, although they did say that immediately after their move last week. So we know that there's a tolerance for, you know, some increase in 10-year yields, but just not too far just yet. What we don't know is that if that's going to change over time. Will they allow us to move up to 1% in 3 months or 6 months or 9 months? It's very difficult to determine. But, you know, what I will say is that there is some positive economic data coming out on the wage front in Japan. We did have a positive announcement a recommendation from the government with respect to minimum wages. We've seen some more data showing some tightness in the labour market. So the fundamentals are moving in the right direction in terms of moving away from this very soft monetary policy. But we all know it's going to be pretty slow.
Hey, Jane, thank you. Jane Foley there of Rubber Bank. We're all trying to figure out what the Bank of Japan is up to. It is clear, based on actions of the last week or so, they don't want to take the elevator up from 0.5 to 1%. They want you to take the stairs slowly. And each step is like 5 to 10 basis point increments. Then they come in, $2 billion of purchases. A few days later, yields start to climb, 5 basis points. They come in, a couple of $1 billion of purchases.
So is this the playbook that every day they can go up about 5 basis points and then until they reach 1%? The question is, why did they set the target at 1% for 10-year yields, that was when they were going to come in and buy, if they didn't want the move to be straight to 1%? Right? So what was their thinking in terms of setting that as a sort of benchmark and then penalizing people who want to bet on that benchmark, right? I mean, that's essentially what happens. If you are a trader in Japan, I believe there are about 5 left, of bonds, but if you start
generous.
If you start to, you know, really try to work out the valuation, you're just playing with fire. I mean, you're just daring the Bank of Japan to come in.
Technically, the target's still 0 and the ceiling's still 0.5, but it's not a ceiling, it's not rigid. And they'll come in at 1%, but they haven't just come in at 1% every single day. They've come in at like 0.6 and 0.65. I'm still trying to figure it out. It's been a week and 2 days of action. I'm not sure anyone really knows what's going on still. Equity slightly negative from New York. This is Bloomberg.
For the first, call it 18 years at Chipotle, This was, you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Equities on the back foot. Cricket term, I think that is, so excuse me. Equity futures on the S&P 500 negative by 0.2%. The Nasdaq down by about 0.36%. Looking at the Russell, we're softer there by 0.1%. Equities down for the last couple of days, and maybe we make it day 3 on the S&P 500. Yesterday, on the S&P 500, the biggest one-day drop going back to April, the first drop bigger than 1% since the month of May. And the blame game has been played in the bond market. Yields are up this morning by a couple of basis points on a 2-year. It's the longer end where we've seen this move. The 10-year's up by 6 basis points to 413.85. The 30-year is up by 6 or 7 basis points to 424. Lisa, we're at highs of the year on a 10-year, and I do think we have to try and strip it down to what was driving things in the last 24 hours. Was it the supply? Was it the better than expected economic data, the ADP report that people don't care about until they do? Was it the downgrade? Is it the BOJ yield curve jitters of the last week or so, or is it just all of the above?
Well, it had been creeping higher, right? It wasn't like suddenly there was a seismic shift upward. The yields had been creeping higher, and suddenly people care about it. And perhaps it's because we've breached those thresholds of year highs, but it's also because of the supply. And I say this because on Tuesday evening, when the news really broke about the Treasury Department and what their plan was in terms of how much they were going to issue, you saw a pretty significant move in the 30-year yield. This was a direct response to the expectation of more supply at a time when the Fed was not going to be buying because they're stripping down their balance sheet, at a time when there are fiscal concerns, and at a time where there are the BOJ operations and a whole host of other issues.
$1 trillion this quarter, up from what we thought was going to be about 733 billion only back in May. That's the story with the bond market. Let's just finish on foreign exchange. For the euro at the moment, we're shaping up as follows. We're negative here by 1/10%. Stronger dollar, 109.24. Stronger dollar against pound sterling too, 126.54. There was a feeling only a month or so ago before the latest CPI print that maybe the BOE goes 50. And now it's been pared back to 25. I would say the consensus is around 25, but some people still think, Bramo, in 30 minutes' time, maybe they go bigger than that.
How much does this all have to do with home prices? How much does this have to do with the fact that people are getting really concerned about suddenly their mortgage rates spiking? I mean, we hear this from Rishi Sunak a bit.
We're going to hear more about it. It's going to get worse based on how these mortgages are going to roll off in months to come. I would say this backing away from 50 is more to do with just CPI came in a lot softer than anticipated. That sort of bailed out maybe a little bit Governor Bailey, but I still don't know. I think it's on a knife's edge, 25 or 50. And if they deliver 25, can they back away in the same way Chairman Powell did and give you the and ah about the next meeting? Or do they have to lean into the idea that maybe there's more to come?
If I look at the notes coming out, a lot of people are talking about 25 and done from the Bank of England, which still has a 7.9% headline CPI rate and is the highest among G7 nations, which shows just how much the narrative has shifted away from further rate hikes globally.
Sterling right now, 126.53. Under surveillance this morning, the Bank of Japan wading into the bond market for the second time this week to slow gains in benchmark sovereign bond yields. The central bank adjusting policy to allow for 10-year yields to rise to as much as 1% on Friday. But its actions this week making it clear it won't allow it to happen too fast. Yields just creeping a little bit higher, Lisa, in today's session.
Hello, confusion. I mean, honestly, there's nobody who really understands what's going on here. I mean, one fund manager over in Japan said it's too early to tell whether they are focusing on the level or speed at which yields rise. And if they are focusing on speed, what is that speed that's allowable? Is it 5 basis points? Are they going to keep coming in? Or is there going to be a new level where the levels matter and they don't want to raise rates all that much in a de facto manner? But who is trading this? Again, who is playing this game of chicken with the Bank of Japan? That's what I was wondering.
The BOJ owns half of the market, if you can call it a market. All of this bond market stuff, drowning out the politics. Today, something truly historic once again. The former President Donald Trump, due to appear in a Washington federal court later on, after being indicted on Tuesday on charges he conspired to obstruct the 2020 presidential election. The 4 p.m. hearing is the 3rd criminal court appearance for the former president. AMH is going to join us in about an hour from now, so look out for that conversation. I also wanted to squeeze in this as well. We touched on it briefly. If you're just joining us, welcome. We're going to be talking about this in about 15 minutes. 6-time Super Bowl winner Tom Brady turning his attention to English football, investing in Birmingham City as a minority owner. Brady is investing in the second-tier championship club alongside hedge fund manager Tom Wagner, who purchased a 45% stake just last month. The pair have also invested in pickleball together. We're going to catch up with Mr. Wagner himself, Lisa, in I think about 10 minutes.
Again, I want to understand the entertainment and the sort of marketing factors behind this. We know that Tom Brady is a genius at marketing with a whole host of a number of endorsements and products. How much that's going to be part of reviving a team that has been on the back foot for a long time? Is this going to be a story of revival that will be represented in, movies and Netflix series?
I hope so for the local area. I do. And the long-time rival across town, Aston Villa. I will disclose that the English side of the family are Villa fans. So
okay, so you're going to come in with boxing gloves on?
No, I just to put that out there. I don't support Aston Villa. As everyone knows, I'm an AC Milan fan. Tom Tsouras joins us now, head of fixed income research at Strategas, a Baird company. Tom, good to see you, buddy.
Yeah, good to be here.
Great to catch up. Let's talk about this bond market. Lisa and I spent the first, 35 minutes of the show trying to work out what was driving things. Was it the data? Is it a BOJ? Is it a downgrade? Or is it just down to what we think it is, the supply coming out of Treasury?
Well, I think it's all of the above, but let's start with the BOJ. This really started with the BOJ's decision last week. What the Bank of Japan has really done here is they've reduced the global demand for sovereign bonds, and they're doing it slowly, as you mentioned. They're not letting that 10-year JGB rate ratchet up to 1%, so they're being cautious because the speed does matter here along the way. But that's the first kind of step here to getting us to the point we're at right now, where bonds are in turmoil. That reduces, we'll call it the demand surface for treasuries, bunds, JGBs. Then you have the refunding announcement, which came along you had the Fitch downgrade, which came along on Tuesday night. That's going to also reduce demand for treasuries. Then finally, we get the refunding announcement where the Treasury says we're going to upsize our coupon auctions by $2 to $3 billion per month across pretty much the entire coupon stack. So it's a supply issue as well. You throw in some strong economic data in there, and you're really getting a flight from quality at this point in time. Now, we think that's going to be fairly limited because the longer this goes, the more it's going to jeopardize the economic expansion. It's going to jeopardize the financial markets. But for now, right now, investors are stepping back and saying, we're going to wait to see how far yields rise before we step in.
You're in touch with the buy side. Let's go through that a little bit more. Is there that demand waiting there to come in and lock in something with a 4 handle for 10 years?
We think absolutely there is. Let's just focus on the 10-year Treasury. There's an awful lot of, we'll call them plain vanilla funds that would love to step in and buy a 10-year Treasury at 4%, let alone 4.20 or 4.30. But they want to see how far this goes because they're not levered investors. They're more or less benchmarked investors, and they want to wait until kind of, things stop falling. And they'll step in eventually, but they're waiting.
The fact that they're waiting, though, is telling. What are they waiting for? What's the all-clear signal?
Well, I think the all-clear signal would be that you have a capitulation where you start to see shorts just absolutely getting squeezed, which is not happening yet. And you see sentiment really just turn completely bearish on treasuries. That would be your buy signal to step in. So we could look at things like the cash market. We could look at whether or not certain instruments are trading special in the repo market. That's just not happening yet. So that's telling us the shorts aren't yet offsides.
And we do have Bill Ackman betting against 30-year treasuries in the options market. He put out on Twitter saying that basically everything going on, he can't see the bull case for 30-year treasuries. That said, where will they settle out given this global backdrop, right? I mean, it's one thing to say, okay, there's more room to run for the sell-off. There's another thing to say, just going forward, it's going to be a higher risk premium on some of these securities simply because of this backdrop.
Yeah, absolutely. And now we have multiple time horizons here because first things first, we might have to get through a recession in the next, we'll call it 6 to 12 months, which could easily push Treasury yields, 10, 30-year Treasury yields lower. But when we get through that, the other side, you're looking at long-term demand for long duration, again, beginning to deteriorate in the expansion. So we're talking about Treasury yields settling higher highs and higher lows into the next business cycle. So where should 30-year Treasuries settle? Well, realistically, we'll say something on the order of 25 to 50 basis points north of 10-year Treasuries. And 10-year Treasuries should probably start to settle around 5% in the next cycle. That's not right now. We've got to get through this recession first, supposedly in the next few quarters. But beyond that, around 5%.
That is the reverse of the previous 30 years.
Yep.
Bob Michael was in your seat from JP Morgan talking about exactly the same thing. Higher lows, higher highs. Yep. We had this headline from Mike Gapen of Bank of America just yesterday. It was about throwing in the towel on the recession call. And of course, a lot of the media went with that call, including myself. And then you actually read the note. And further down the note, the real call is the rate cut call from Mike Gapen. And I'm going to share the numbers with you. Just 75 basis points of cuts in 2024, 100 in 2025. And he thinks we get an additional rate hike. So you think about the kind of numbers we're coming back down to. He's thinking we come back down to maybe 4 on Fed funds. That is completely different to everything we've seen over the last 15 years. Is that where you think we settle down at? Something in and around 4 if they do indeed start cutting?
What I've been saying is somewhere around 3.25, now 3.50. Now I could see maybe a 3.75 to 4. So we're raising our floor on the Fed funds rate. 4 might be, I think we go a little lower than that because I think inflation is going to come down to about 3% and stay there, and maybe even go a little lower for the next, we'll call it 6 months or so. And so the Fed has some room to come down to maybe a 3.50, but I don't want to split hairs here. They're not coming down to 1%. They're not coming down to 2%. They're coming down to something above 3%, in my opinion, in the next downturn. So 4%, certainly reasonable.
How much have the events of the past couple of weeks changed your investing outlook in terms of higher benchmark yields and potentially more longer-term refinancing risk, frankly, for a lot of companies that may have avoided having to refinance till now, but at some point are going to have to face it?
Yeah, what this is doing to us, and in our view, is helping shape our view, is that the bill is coming due fiscally for the U.S. government, for state governments, and for corporations who have had way too much debt and have been able to use cheap financing to kind of keep cash flow going. The bill is coming due. So what this means is we should have not only steeper government curves, but steeper credit curves going forward. When that happens exactly, well, we probably have to get through this recession. But again, on the other side of the recession, we're probably looking at higher borrowing costs for everybody, from U.S. Treasury to Apple to CCC credits.
Are we underestimating how much this is going to bite? Lisa mentioned the housing market in the UK. If you're coming off a 2-year fix, 5-year, whatever it might be, your jump up in mortgage costs is just going to be, it's going to feel for some people astronomical.
Yep.
And if I think about some of the coupons that some of these high yield companies are paying from debt they issued several years ago, when they have to come back into the market and reissue wherever that maturity wall might be, the step up is going to be so severe. Are we burying our head in the sand on this one and not really thinking through how large the step up in interest costs is going to be?
I think we are, and I think part of the reason for that is because on the sidelines for the last, we'll say, 6 to 12 months has been this surge of private credit, which has been helping to kind of facilitate the transition towards higher interest rates, particularly across the lower quality corporate portion of the credit space. That will not be there forever as a liquidity backstop, and eventually many of these companies are going to have to come to market, do public bond issuance at much higher rates. That's probably not happening this quarter or next quarter, but next year, absolutely.
This was great, Tom. It's good to get your thoughts. Tom Titsouris of Strategas. Lisa, this is going to slowly bite and then all at once. And it's going to bite in different ways in different places. Obviously, the UK mortgage market, and we've talked about this so much, is so different to what we experience in the United States. If you've got the 30-year fix at 2%, whatever it is, great word. Well done you. Well done you. It's honestly,
yeah, I know.
It's
the
real
biggest
envy. It's real envy. I wish.
You're welcome.
I wish. But you're going to see it bite.
But you're going to see it bite in a material way. And this, to me, I think that you ask exactly the right question. Are people accurately really pricing in or understanding the implications of this? Can you price it in if it's that far out? Because people want to make hay while the sun is shining. They want to take advantage of a rally that seems to have legs. But longer term, if we start to reassess that the Fed, and not just the Fed, but the ECB too, is going to err on the side of not raising rates higher, but keeping them at these levels for longer, that could be potentially more economically damaging than if they were to overshoot and then have to retrace their steps.
You stay at 4, you come down to only 4. If that's a new floor, if Mike Gapen's right, you'd imagine that's going to hurt.
Just a bit ago, a year ago, 2 years ago, we were talking about average investment grade bonds below 4% all in. So if you think about all these companies who've refinanced, well, what's the premium suddenly that they have to pay in an era where money costs something? This is going to be a sea change for markets that finally might see some of the pain of getting back to normalcy.
Bank of England rate decision about 17 minutes away. We'll take a break from the market just briefly. We're going to catch up with the Birmingham City Football Club chairman, Tom Wagner. We're going to do that next from New York City. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The trajectory, our fiscal trajectory, is concerning. But we're a rich country and we've got time to deal with it. But we need to do some things in the next few years to change that trajectory. And to do that, it's going to take doing things on both the spending side and the revenue side.
You can't do with just one party. You have to do them in a way that commands broader support across the political spectrum, and you have to build that.
What a timely conversation. Former US Treasury Secretaries Hank Paulson, Tim Geithner catching up with David Westin for Wall Street Week. No doubt you'll hear more of that on Wall Street Week through the weekend. I want to skip the markets just for a moment and get straight to this conversation. Joining us in the studio, I'm pleased to say, Tom Wagner, the Birmingham City chairman and co-founder and co-chairman of Knighthead Capital. Good morning to you, sir.
Good morning.
Purchasing Birmingham City. I think we've just got to start with this. We've spoken a lot over the years about Americans getting into English football. And Lisa and I were talking about how many leagues there are in the United Kingdom. Why this league and why this club? And if you were thinking of all of these clubs as opportunities to invest in, what was it about something of this size in this location that got your attention?
Well, after a year of really looking at the landscape of English football, we were drawn to Birmingham for a number of reasons. England's second city, one of the youngest, most diverse populations in all of Europe. It's a city on the rise that is going through a significant transformation. So all of that made the city of Birmingham quite attractive. And then add to that a team that had been underinvested in for a long period of time, and frankly, to us, seemed quite a bit like a sleeping giant. You know, it seemed impossible to us that you have the second city in England with the named team in the championship. And so we felt that there was a huge opportunity to really make a difference.
As you know, that league is highly competitive. Very, very difficult to get promoted because you also have to face the teams that got relegated from the Premiership, who've got all the money to try and get back up a league. So why this league? That's what I'm trying to get my head around. When we think about the lower leagues of English football, a lot of Americans have been introduced to Wrexham and what Ryan Reynolds is up to. Lower league club, maybe get a little bit more bang for your buck. You get that promotion, you get some more. Right. Why this team in this league?
Well, it's a team that had been in the middle of the table for a significant period of time, and we felt that there were substantial resources available. And by the way, this isn't just about the men's first team. We have a spectacular academy. We have a women's team that we think is poised to be, you know, one of the best in England. And I think when you take all those things together, coupled with a very large natural fan base, we just felt that the team was underperforming, meaning the club itself was underperforming from the perspective of treating the fans properly, being a real part of the community, and embracing this incredible natural fan base that it has within Birmingham. So if we provide a product that is actually commensurate with the value of the city, we think that there'll be great things ahead for the club, you know, and beyond.
So I know you from a previous life when you focused on distressed opportunities, and you came in here and you said not distressed opportunities, turnaround situations, which is applicable to this. And I'm wondering, at a time where there is so much interest in investing in sports and football, if this is the playbook more people are following as Middle East money kind of pushes everybody out of the top leagues.
Well, I think that when you look at the investment from sovereigns, it's very difficult to compete in the highest level of the top tier in football. But there's an enormous opportunity to compete in everything else within football across all of Europe, frankly. But I think English football was particularly appealing to us for the reasons I cited earlier. I mean, it was really very much about Birmingham and what we believed was a city that was going through a significant transformation. And we felt that the club could play a big part of that.
You've taken a 45% stake alongside Tom Brady. Lisa and I were talking about this. Is Brady just along for the ride for branding? Has he put real money into this venture alongside you?
Yeah, he is not here for promotional purposes. And obviously today is all about, having Tom be very visible. But really what it's about is Tom bringing his expertise following a 23-year career in the NFL, which is highly competitive, as everyone knows, where he had unparalleled success. I mean, if you think about the fact that Tom played in 10 Super Bowls in a 23-year career, won 7 of them, was only, favored, I think, twice, if I remember correctly, in those Super Bowls. That's a pretty incredible track record. And his level of excellence never really tapered off. So it's about bringing those learnings to Birmingham. And so Tom will chair our advisory board. He will have a significant role in health, wellness, nutrition, effectively human sustainability, and will play a role in how we think about player interaction.
So will we get to watch what it means to have human sustainability on a Netflix series that's coming out shortly?
We'll see. I think, those things would be fun and exciting, but our principal objective is to really bring what worked for Tom, and having known him for a long time and witnessed firsthand what went into his success over a long period of time, these are legitimate activities that really do play out in a positive way in how our athlete performs.
We can't just let we'll see hang there. We've got to dig a little bit deeper. Are there talks with anyone currently about doing something on the media side?
I think, if you look at Birmingham, there's one individual that I think really stands out as it relates to producing fantastic content, and that's Stephen Knight. So if we were to do anything along those lines, we'd have to engage with Mr. Knight and see whether or not he were interested. So he's a wonderful guy. He's produced some and created some amazing content over the years. So it'd be really exciting if something like that could happen.
It raises the question as to whether when you came up with the appropriate price to play for this, whether content was something you were thinking about at the same time in the same way Liberty Media did with, say, Formula One? Was that a consideration?
Yeah, everything is a consideration, right? And it starts with what is the product that we're delivering to the fans? It has to be something that is worthy of, the city, the people, the fan base, and their passions. And when we went to our first game, it was not consistent with what we felt the fans deserved. So that will be the beginning point, right? It's about an overall experience, and that experience goes beyond just match day. You want to provide content, you want to provide enjoyment to the fans all the time, so that they really feel a part of the team and they can be proud to support the team. And ultimately, part of that is drawing in fans from beyond simply Birmingham. I mean, I think Tom's involvement brings in a lot of attention. Having Undefeated as our kit sponsor on the men's and women's team. First time the same sponsor's been on both the men's and women's jerseys. Doing that, so we have this connection with an LA-based streetwear brand. These are different things. It brings a level of attention to the club that I think is demonstrative of how we're going to approach this, which is to do things differently.
Is the monetization going to come more from the content and the branding of it, or the actual ticket sales, right? Is the idea sort of the larger thrust of the team?
All of it. You can't do, I think in sport today, you can't be successful doing one thing properly. You have to do everything properly. And this is a business, to some degree. It's obviously one that has a lot of passion behind it. But we have to think about, as you would in any business, getting every element of the business right. So we have to think about promotion. We have to think about the product that we put out. Not just the tickets and the product on the pitch, but also what's available for the fans. Do they like the kit that they're able to buy? Are there good pieces of swag that they would enjoy wearing, right? All of those things matter. And then you can think about partnerships, and obviously commercial partnerships here will be critically important, and we're looking for the right commercial partners to begin this journey with us. I promise that corporations that step up and become a partner with us will have a long ride that they won't regret.
It's early days. Let's talk about defining success. Have you seen that success already through season ticket sales picking up ahead of the new season?
Absolutely. It's been...
Is it a multiple of this previous year?
The stadium capacity is what it is, but we are well ahead of where we've been in prior years. We're going to increase stadium capacity by roughly 50% with some repairs that had been long needed. So we'll open a substantial number of additional seats. There's safe standing that's going in, which is something that the fans really want. There'll be much better hospitality. I think everything in that regard will increase. But ultimately, the goal will be to, keep people coming back, and that means that the match day experience has to be enjoyable. And I think we'll measure success based on, can we make continued improvement? I mean, everyone would love to see a spectacular season right out of the gates. I think we have a team that's perfectly capable of doing that. But ultimately, it's about keeping our eye focused on the long goals, which is consistency.
So let's do this. Let's agree now. I'll get a camera. You get Brady. And we'll go down to St Andrews in the new season, and we'll do a bit of content ourselves. That would be cool, wouldn't it?
That'd be great. That'd be great. We'd love to see that.
Let's do that.
It'd be fantastic.
Very cool. Tom Wagner, thank you, and good luck for the new season. This is very cool. Tom Wagner there of Knighthead Capital. This is really interesting, Lisa, to see how this is going to develop next couple of seasons.
I think I just heard an invitation to Stephen Knight to come join
that too? Okay, great.
British screenwriter.
We'll get everyone together. We'll do that. Bank of England rate decision just around the corner. We'll get Governor Bailey to come.
I think that would be great.
Down Broad
See
Street,
what he has
Birmingham. To say. Yeah, why not? Why not? Futures negative here by 0.25% from New York City. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
When rates are rising and cyclicality is still outperforming, I think it's a message that the market's comfortable.
Are people really going to be willing to accept a 4% 10-year note? It seems so high to us because it's been so low.
Those terrible fiscal trends are going to remain in place.
No central bank is stopping governments from issuing debt.
The options market in general is absolutely terrible at pricing political and geopolitical events.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Here comes another rate hike, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Some interesting moves in the bond market developing over the last 24 hours. A downgrade from Fitch, the United States losing its AAA credit rating. On top of that, we've seen some better data in America.